We are live.
Okay, welcome everybody. Markets have a little reality this morning as all the banks have come in and begun hoarding billions of dollars for what they forecast will be delinquencies in mortgages. JP Morgan's predicting we're going to have depressed profits for not just 6 months, not just a year, but 2 years. So stock market bulls will have to be betting on PE multiples that are going to happen in 2022 at this point to remain long in the current PE multiples that are around 19, an all-time high. And this is with everything crashing around us. So this is a shot from the Great Depression. $100 will buy this car, must have cash, lost all the money in the stock market. Okay, the title of today's trade alert is that this is the greatest profit opportunity in history on a silver plate. It's not to buy silver yet. We'll take a look at whether we feel like there's a deflationary force coming our way or an inflationary force. My expectation is, again, extreme deflationary, which gives the Fed ammo because of low inflation to pump the economy with debt, and then that will eventually turn into inflation. I do think gold bugs are quite a bit early and have some pain ahead. So if you're over leveraged in gold, careful. The biggest opportunity, I believe, is shorting the stock markets, particularly the US stock market and the Chinese stock market, as I do believe these two countries will be going head to head and battling it out in the coming decade. And that there may be a quite substantial catalyst leading into the election, placing all the blame of this current fiasco rightfully on China. So I think that's going to be the big catalyst that catches markets unprepared beyond just a sleuth of gravity of bad profits, bad earnings, bad forecasts, bad unemployment, bad delinquencies, really just clogging up any hope to be long the stock market. Okay, so we've seen this massive rebound, people hoping on a V-shaped recovery. Trump's talking about reopening the economy. You know, he likes to have phases. This will probably be something like a 20-phase plan to reopen the economy that's going to take years, and we'll end with a vaccine at the very end of the mouse maze that they're putting us through here in markets, not just letting them behave normally, but trying to manipulate them, making our job quite difficult. Okay, so let's take a look at the trade alert. And I'm going to start off actually by going down to our track record. I know a lot of people want to know, what are your results? So we have 4 portfolios to follow. We have our Pro portfolio, great for accounts over 75,000. We have it with the Bootcamp, which is our best performing strategy currently. Bootcamp puts on a few speculative trades that are highly leveraged with tiny amounts of capital. Those are paying off handsomely right now and have offset the drawdown I have, at least in my put option portfolio. Now, if you joined later, you probably got a much better price point on your puts, but you missed out on some of the handsome gains we had earlier this year in the bond market. So this is the return we currently have, just about flat. I do want to point out that the put options we bought are something like insurance that cover us for the next 24 months. So if you did cost average out the duration of downside protection or profit opportunity, it's really not a big deal to have some drawdown in the first month you put the position on, because this is an opportunity that comes once, then it's gone, and it's not an opportunity that will likely be here again for probably at least another decade. And that is, again, to catch a large drop in the S&P 500. And in retaliation, I do believe we're going to see China's stock market crater as well. Okay, so we have a Pro strategy, which we'll review today. and they're both about flat on the year. They had a substantial return in March, but we're hurting a little bit on our put options when we first put them on. If you're new, you're coming in at a great discount on this exact setup, and we've been holding tight for quite some time. Now, for people with a little less capital, we have two other options. We have a basic membership. We're just going to trade the US equity markets. The basic membership's good for accounts between 30 and 75,000, and we'll use options, but it's only going to trade US equity products. It will not trade the bond market or the commodities market, as well as it won't be trading the Chinese stock market. So because you have less capital, we want to keep you focused, keep your investments at something you're comfortable with. And so what better than playing the US equity market for people with smaller accounts? Now, very small accounts, you might really enjoy our buy and hold portfolio. It actually is designed to have greater return, but greater volatility, and it uses no options. And this portfolio is very easy to follow if you have less than $30,000. In general, the more advanced our strategy, our goal is not necessarily to make a bigger return, but rather to make a safer return with less volatility. And the only way to really do that is to diversify your assets into uncorrelated products. And so this pro strategy takes advantage of the bond market, primarily the US debt market, treasury market, and allows that to really protect our equity positions. Okay, so with that said, let's go through the trade alert from head to toe and look at what we have in store for investors today. So as you know, I've been saying since really February and early January that there was a crisis unfolding which would destabilize economies and governments. We got to be careful about the wording of how we describe that, as you can easily get yourself censored on YouTube these days. So you guys all know exactly what I'm talking about. And if you got out early, you did really well with that recommendation. And then we saw the market just free falling. It was at the 240 level when we first put on these trades. A day after, it literally crashed 220. We were extended in the futures market a Sunday night, and the Fed came in with trillions of dollars of liquidity. And we had this massive rebound in the markets up to the 280 level. So we haven't changed outlook positioning whatsoever. The US stock market is worth over $28 trillion. So when you combine that with all the losses that are occurring in the real estate market, in the credit markets, and the massive deficits that the US intends to sell this year, which could quite likely be going from $1 trillion deficit to probably $4 trillion deficit. Well, you can quickly realize the amount of money the Fed printed bought them maybe a month or two of time, but it will not be enough to offset all the losses occurring worldwide. And so, think of the Fed throwing a baseball in the air. It's quite impressive how high they could throw it, but we still know what that baseball is going to do, right? It's going to come right back down because of the gravity of the situation. So currently, our strategy is to have dry powder, cash, with most of your portfolio. If you're following our basic membership, which trades Monday, Wednesday, and Friday, and all you have to do is buy to open the following set of put options, which again are designed to create profits, but more importantly, we're going to be holding into our puts at the same moment we enter into US equities, which I believe will be sometime around September. August or September is when I think we're going to hit a short-term bottom where we can invest in a select group of US equities. Now, to be clear, I don't think most of the S&P 500 will be healthy when we get 3 to 6 months down the road from today. But a few select companies relative to their peers will be outperforming. They'll actually be showing better revenue, better profit growth compared to all the other options. And this will quite likely be due to government handouts, which I believe will be focused on a handful of ETFs. So we're going to be focusing on picking up healthcare, biotech, medical device, e-commerce, and Aero Defense ETFs, XLV, IBB, IHI, ONLN, and ITA. My hope is to get the quality companies, which will be these, at half off, and that this Aero Defense ETF could potentially be more like 60 to 70% off. Now, there will be a risk, if I'm correct, that this stock crash is playing out, that we could go beyond a 50% correction, in which case these put options will be absolutely critical to protect our downside risk when entering into that position. So the put options, again, act as the foundation to the house we're building. The house represents your nest egg, your trading plan. The walls will be the stocks we're going to buy. In this case, right now, your walls are built with cash. And by having put options and cash, you'll be one of the few investors who have capital to put to work when the rest of the world has suffered massive losses and is scrambling, selling at the bottom because they're worried about being able to pay for their future. So again, the put options act as leverage, a loan, to be able to get a lot of extra capital if we're correct. Plus, we have cash on the sideline. So this could be two of the greatest opportunities. First opportunity is recognizing that the stock market is going to be pummeled lower and lower by the gravity of the situation. And then the second opportunity will be having the insight to pick up the right companies who actually benefit from the paradigm shift that our economy is entering. So most companies, S&P 500, are not going to do so well. And again, we still have to see a general reset, a general discount before I'd want to enter these positions. So for anyone following our Monday, Wednesday, Friday program in the basic membership, that's really what you have to look forward to, is you get in cash, you buy this set of put options. This is based on a $75,000 portfolio. And then you sit back and wait for the right time to rotate into this group of high quality US companies who will benefit substantially from what's coming. Now, I know some of you are following with less than $75,000. So my recommendation would be to simply remove these two puts. So you can follow this accurately with $30,000 by just making that tiny change. If you're going to do it with 75, then I would keep those two in place. Okay, so that is a good review of our basic program. If you're trading between $30,000 and $75,000 in capital, that's really my best recommendation for you. I think we're going to see the highest return, obviously, on our puts, but we're going to use a lot less capital because it's so much riskier to buy put options. The bigger money profit will be putting a great deal of your capital to work when the market's at an extreme discount. Okay, so let's move to part two. So if you are following our program on Thursdays, we consider you a pro member. And this is where we're going to actually take your portfolio to the next level. We're going to do the strategy Ray Dalio has made quite famous, but really anybody who knows what's going on does this strategy. And so I call this the roof to your house is the bond market. So we like the TLT, that's your 30-year treasury. And the big picture is that trillions of dollars are going to have to be funneled into this TLT. It's going to be paid for first by central banks, second by primary dealers, third by big hedge funds like Ray Dalio, and then a few small retail folks will probably have a clue what's going on. But if you want to follow the money and you believe that the rich don't like to lose, I can guarantee you one thing. The big capital, and we're talking trillions of dollars, are going to be funneled into long-term government debt worldwide because the governments must bail out the private sector. And this in itself is going to be devastating to the stock market because it's going to be a risk-free trade for the super rich who understand the mechanics of the financial system to take complete advantage of. So if you want to follow the money, it's escaping real estate and stocks. It's loading up in government debt. That's really phase one. Phase two is you get your stock crash, and that money will be vacuumed out of the central bank's hands and the big primary dealers like JP Morgan, and it's going to go right into the abyss, which is the Fed's balance sheet. They're going to vacuum up all these treasuries for a profit after enough money has been raised to deal with the problem. And then these big banks get to do what? They get to buy stocks at extreme discounts. And it's no coincidence they've done this in every crisis for the last century. And we'll review all these crises over the last century so you can see this is exactly what happens. Every time the Fed cuts rates to zero, they know there is a terrible period ahead. TLT goes up, the SPY goes down. It's really that simple. And I'll show you proof in a moment. But if you do join our pro membership, you get an extra webinar on Thursdays. Now, normally we wouldn't be covering this content on a Wednesday, but there's just not a whole lot for people to do. So I do feel like it's prudent to give you the entry trade alert for our pro program. And this again will be free until the stock market crash begins. So you'll get to see how we're positioning our more advanced members, even if you're just in our basic membership. Now that won't last forever, and soon we'll be only covering this content on Thursdays. Let's take a look at how we have the rest of our portfolio positioned if you are indeed in our pro membership, which trades on Thursdays. Okay, so per 75,000, we have 200 shares of the TLT ETF. And again, we're not trying to collect 1% yield from a 30-year treasury for 30 years. You got to realize there's two aspects to a bond. There's the yield, and then there's the bond value. If the yield goes lower, the value of the bond goes up. And that's what we want. We want yields to go lower because growth expectations are being crushed, inflation pressures are being crushed, interest rates at the federal fund rates are at zero, and that's the perfect recipe to crash a stock market and create a bull market in bonds. And that is indeed our prediction for 2020. So this is another safe way to bet that the stock market's going to have trouble is to own the 30-year treasury. That's our biggest position. And again, it's the TLT ETF. Now, gold has been doing really well in the last 48 hours. And because the US has begun to devalue its currency, that gives it an unfair advantage against every other country. So what's every other country going to do? They're going to go sit there and print their own currency. So the knee-jerk reaction has been one in which people believe to buy stocks in gold because of all the money printing. But the problem is that our big economic shock is a demand shock. Everybody's losing their jobs. They're getting a little bit of cash slowly delayed from their government, but it's not enough, and it's nowhere near what they used to make. So really what we have is a demand shock, which will create a deflationary nightmare for stocks, and I believe also for gold. So because there's such massive QE, we do have a gold miner position, which again is a little bit different than betting on spot gold. So we'll take a look at that later. But we're not just long these two assets. We actually use the married put strategy. So we want our put option to go to zero, and we want the ETF to appreciate. So again, this makes us have a maximum loss the day we put on the position, which is the cost of our put, and gives you a lot of protection to jump into positions early. Now, also, I'm very aware of tax obligations. So my goal is to get into ETFs I think have long-term promise early and protect them with put options so that we can get to the 1-year hold time frame as soon as possible and have the opportunity to begin taking profits at a lower tax rate before everyone else. So that's a big strategy that we take advantage of here. So right now we have this set of open options related to the TLT, one of which is a super cheap put. And again, we want those puts to expire worthless. Every Thursday, we're going to be rolling that put. My expectation is TLT goes up, SPY and gold products go down within the next 90 days. Now, could I be wrong on gold and gold just stays elevated while stocks crash? We could, but it's not really the case in history that plays out. Now, this time's different, and I'll show you what's incredibly different about monetary policy today compared to 2008, the dot-com bubble. We can look at the runaway inflation in the 70s, and we can go back to the deflationary shock of the Great Depression and try to put it all together here. But currently, we do endorse this set of options. However, these two, realize, we'll be getting rid of tomorrow and rotating our TLT put into next week. Now, I am on standby to add risk to our portfolio until next week. I think the current push we've seen is going to run out of steam without some sort of fundamental benefit that gets value investors to buy and hold at this point. So right now we have all the momentum pushing investors sloshing the markets around, and I do think that's going to run out of steam here next week. So that's when I do anticipate adding some risk to our put options and adding in some new TLT call options. They're really the only two changes I have coming, and I will wait till next Wednesday and Thursday to make those changes. But this Thursday, you can count on us taking a profit on this short-term 417 TLT call. So if you do get that today, expect to flip it tomorrow. And again, this put option is in case of something that would be absolutely terrifying, is the US bond market starting to crash. So we're buying that cheap put. We're going to trail the TLT. I'm looking for a short-term bounce in the TLT in the next 3 months towards 180. And that's where I do anticipate us cashing out all of our leveraged call options, buying it at the money put, and then again, still remaining long the TLT because we want to get to that 1 year mark before we start managing that. Now, TLT probably has a 2 to 5 year run up. And again, it's really, if you want to play the bond market, especially US debt products like the treasury market, you're really betting that there will be a acceleration of growth of debt. If you want to play the stock market, you want to hope that there's going to be an acceleration of growth and profits. So it's quite clear to me that we're not going to have an acceleration of growth in profits in the private sector in terms of the stock market, but it's almost certain that we will grow the US debt at the fastest pace in history. So that's really good for betting up in bonds when you understand exactly how this all works. So again, this is a set of options. If you want to take these short-term ones, realize we're going to flip those tomorrow. So if you don't want to join in on these two, just realize you should wait to buy your TLT shares until tomorrow, because I will give you a new put option. And that is the critical downside protection we want to have at all times. Also, take a look at oil prices, and you can have a good idea of just how healthy this economy really is. Oil is really the ultimate resource. Until oil's back at 50 and inventory levels have been drawn down, you can bet that there's going to be troubling times ahead. Okay, GDX, again, we're not just long, we have the married put. This one says hold, don't buy. That means don't buy. If you already bought it, don't sell it. I'm going to look for a better opportunity to sell that put, as I do anticipate some volatility ahead in our gold miner position. Now, I'd love for gold miners just to keep rocketing higher, and it is doing very well lately. But in the grand scheme of things, I'm not quite sure we have a inflationary shock yet. We might be a year or two early on that. So the only real benefit to own gold is that you can see the future, that inflation's coming, but it's really not here yet. And that's really why you want to play the bond market first. Okay, the last part of our portfolio, we have a in the money put on emerging markets. I wouldn't buy that today, but I wouldn't sell it today either. So we're running out of time to sell that put, but it is in the money. So we do want to catch a nice volatility shock, hopefully within the next 30 days or less, to let go of this put specifically ending on May 15th. And then this put also ending on May 15th. So we'll be looking for a good time to sell those two. The trade I do recommend is to short Chinese stocks through an American ETF, FXI. Now, what's important about that? China is doing a great job with its draconian government in terms of protecting its citizens, getting its economic machine rolling again. So it's actually outperforming every other stock market that I closely track. So it's outperforming South Korea, it's outperforming emerging markets, it's outperforming US equities. So why would we want to short it? Well, because it's quite clear that China deliberately withheld information and tried to create this extreme economic depression. And I believe that the entire world's going to blame China for it and start placing sanctions against it and pulling out their manufacturing. So when you look into the future for China, it's going to be ugly. It's going to be ugly for all, but I do believe we could see FXI go to zero. So that means you get to lose your cost of your put, which is about $1 when I placed it, and you're going to pick up $31. So a 30-to-1 potential return on this trade. Now we only have until November 20th. As Karen pointed out, well, why don't we have a little extra time on that bad boy? What if all this crazy geopolitical tensions really breaks out after the election, not before? So I certainly understand that, and it was a good point by Karen. Do expect I will place longer duration trades when I see fit. So again, I do expect a pretty vicious crash in the near-term future, and then a bounce around September, and that's when I would look to add to this position if they haven't already made the move yet. So the big move would be to outlaw U.S. investors passively investing into Chinese companies through all these different ETF products. One, or two, to revoke the special status of Hong Kong, both of which I do think are coming. I think it could be quite easier to start off by restricting capital flows to ETF products, which I think could happen in 2020. And then perhaps in 2021, they wait to attack China's investment center, which is Hong Kong. Now, could it happen sooner? It sure could. That's why in our boot camp, you know the position we put on that has the 100-to-1 potential return if Hong Kong's special status is revoked. Okay, so that's a review of our strategy. And even though we have a little drawdown in April, I want to point out most of that's from our put options having some drawdown. These put options give us protection for 2 years. So if you average out the cost of our investment today over 24 months, you have very, very, very little drawdown. And we've still been able to create this extremely low volatility return by being ultra cautious. Okay, with that said, I'd like to look at some questions with Dean and our crew. So I'm gonna go ahead and start looking at the questions in the chat box. And then if any customers want to raise their hand who have already paid and joined to talk out loud, please go ahead and do so. And again, I have a lot more content to present, but I do want to make sure we're all clear on the trading plan before we go forward. Dean, you want to say a few comments before we start taking in some questions here?
Hey, Jason. Thanks, bud. Real quick, we
have
Sudhishan.
Hey, Dean. Getting double audio.
Oh, sorry. There we go. Sorry about that, guys. I have some new technical things that are happening on my side. But Sadish is new to the basic program. So I would just say, Sadish, if you do have any questions, go ahead and reference them to Jason now, and he'll help you with any questions you may have. And really, Jason, that's really all I have for now.
Okay, great. I see Oscar's got his hand up. Let's get a little input from Oscar. How's it going, Oscar?
All right, Jason, how are you?
I'm doing good. It's funny how the sentiment changes so much when the stock market's up, although you and I both know that what's really happening on the ground is getting worse by the moment. So
yes, it is. And as you've been stating, I think the only solutions are not ones that are really being talked about, and until they come to that reality, I'm not sure the markets are going to reflect reality, but eventually they do. Today is probably a day, this is the first time I got to take a look at them, but they are starting to reflect what we are in for.
Yeah. So Oscar, by the way, everyone, is an administrator for a number of hospitals, many of which are in Florida, but he also has some in Detroit. And which other cities, Oscar?
We're throughout the country without disclosing who I work for.
Oh, okay. All right. So he's got really very, very good data. And unfortunately, he's been telling me the mortality rate is quite alarming, especially with African American population.
Sources reporting that Saudi Arabian bonds final price guidance will be 260 basis points.
Well, very good, Oscar. It's always good to hear your voice, and I salute you for all your hard work keeping us safe. So thanks for checking in. Is there anything else you wanted to leave the crowd with?
Thanks for all you do, Jason. You are on top of this better than anyone I've seen, at least in the press.
Well, I'm not sure if that says a lot with the press, but I appreciate that, Oscar.
Well, yeah, I listened to the audio last night, the replay, almost 3 hours of it, and I will say Karen's your favorite only because you like to be spanked.
Hey, wait a minute, Oscar. You're in so much trouble.
Bless you all. Take care.
Yeah, bless you, Oscar. Thanks very much. I got a buddy of mine who just lost somebody down in Miami, so he's down there right now. So,
It's tough.
it's a very scary situation. Yep,
Yes,
this is
it
the
is.
second person. Yep, number 2 person he's lost. So it's just not good. So thank you for everything you guys do down there. Appreciate it.
God bless. Bye-bye.
You too.
Let's see. Sadish has his hand raised. I'm betting he wants a review of the basic membership. Is that right?
Hey, Jason.
Hey, how's it going?
Good. How are you guys doing?
Doing excellent.
Yep. Thank you so much. Actually, I just started listening to you from past 1 week, but I heard a lot and so much of knowledge from you guys. I was listening to the TV all the time and they're giving me, this is the low, but no clue what to do and what not to do. But after listening to your session, I just got a lot of information and just joined the team yesterday.
Oh, wonderful. Well, thank you so much for joining and we really appreciate it. Are there any questions I can answer for you today?
Yeah, just to start with, right? Like what are the trades I need to place? That's what I was wondering. Like,
Well, let me ask you this. Are you going to put more or less than 75,000 to work?
around close to 75. I already have like 40K in my profile right now, but I'll be getting 30 more. So in a week, I should be seeing around 75,000.
Okay. Now, do you see yourself just trying to play the basic membership, or do you think you would want to have the full house per se, following the pro membership as well?
I'll start with basic. Maybe I'll just change it as and when we go.
Okay. Well, yeah, let me review what I would do. So if I was starting with 40 and thought I had another 30 coming, and then was considering doing the full strategy, but want to just start off small, then this is your only task today, is to buy this set of options.
Okay.
And again, that's buy to open. And luckily, you're going to come in at a much better price than me. Now, next week, I do anticipate adding to this. So no expectation to sell any of these. I love the strikes. I love the dates. And I do want to point out the 2008 crash, most of it was achieved in 3 trading days. Okay.
Wow.
So it sits there and bumbles around, jumps up, it jumps down, it goes flat. You got low volume, high volume, but eventually the carpet gets pulled from underneath. And then that's when these will really, truly shine. So you have a very easy starting point, but you got a lot of your money just sitting in cash. If you did want to consider following the pro membership, then your next step would be to look at this set of trades. So then you'd be buying 200 shares of the TLT, but protecting it with the married put. Now, when I say a married put, do you understand what the correlation is or what the purpose is of the put option?
For some reason it goes down, then you are covered, right?
Yeah, so it really does no good until you go below the strike. So this isn't going to make a lot of money for us if there's a little drop in the TLT. But if the TLT were for some reason to crater, which I don't think will happen, but if it did, you would be covered with your put option. So
Got it.
you would get the strike. So as long as you own one put option for every 100 shares of the underlying asset, you have extreme precaution. So the put options act as a drag on your return. But when you get the strategy or the prediction wrong, at least in the short term, you're going to reduce your volatility. So our returns have been achieved by doing this at all times. I never, ever have a large position open that's not protected. So not only do I have to predict the markets correctly, I have to pay off all this downside protection at all time, which is a huge drag on return. And we're still coming out with these beautiful, beautiful returns. Joe, please go ahead.
I have, hi, Jason and Dean, and I have two very short questions. At least I hope they're very short.
Sure, please.
The one of them is in regards to the SPY.
Okay.
I have all the SPY options, but you know, they don't have. I don't have entry points that I'm crazy about, and so they're relatively cheap at this point. Are you opposed to dollar cost averaging some of those?
Well, I would say if you're going to add a full 7, are you following the pro or the basic,
Yeah,
Joe?
the pro.
Okay, so if you're telling me I have another 75 grand to put to work, then I would say follow then I would say follow the same plan and you know, so for those of you who are asking me a few weeks ago, should I wait? I told you jump right in. Well, if you waited, you get a better deal today. So sometimes I'm not correct in the short term. And now in the long term, I've been pretty darn accurate. So yeah, I like layering in today. And as I said, I do anticipate per 75,000 that I have managed, I'm going to add to this next Wednesday. And then I'll add to this next Thursday. Now that's different than me saying I have new cash to put to work. If you have new cash to put to work, I wouldn't wait.
Okay. And the second question is the super duper 100 times trade that we were talking about. That's Thursday. Is that correct? Do I remember that that's Thursday?
Yeah, we'll cover it in detail Thursday in the boot camp. And you got the trade alert yesterday. Right.
And yes. And I did my pre-setup things, and so I'm ready to move on that. But I wanted to ask a question, but I'll address that with you tomorrow. So I'm good at this point. I'm going to dollar cost average into the SPY. So I really don't like those those really high entry points.
Yeah, so let's just look at that. So, we can see there's a asteroid coming for Earth is my analogy, but it's hard for us to estimate exactly when it's going to hit and create the impact. We know it's coming, right? There's no doubt that that's happening. I got us in right here with the first tranche of puts. We immediately saw a return, and then they came in with trillions of liquidity, and we got this massive bounce. And I'll tell you, all year I was just praying that we'd get some bounce for me to build that position into. And it just did not look like it was coming, did it? And sure enough, it came. But
Someone was patient.
But but here's the point. We didn't risk the whole boat. So we have a lot of dry powder to add to that position. And so you've seen me slowly sit here and wait for this to run out of steam. Mm-hmm. And I'm going to be able to cut my entry costs and all these in half by doubling down most likely Wednesday. Now, I don't anticipate increasing this one, but I would anticipate us increasing these 4 and potentially adding a higher strike with a late May expiration.
All
So
right,
that's
well,
what
I
would
may wait,
anticipate.
I may wait until Wednesday and have an opportunity to take another look at it, but
The risk is by Wednesday, we could be going back down. So, so I do want to clarify, it's one thing to dollar cost average, which is what Joe's talking about. It's another thing to increase the relative risk of your portfolio. So I've waited to increase the relative risk in our entire portfolio for about a month. And now I do anticipate increasing the relative risk in both our puts as well as our TLT call options coming
Can I
Wednesday,
make a
Thursday.
comment about that, Jason? Because I agree with you. I would disagree with who was just speaking to wait. Because I'm going to tell you, I can tell you what price point I got in at and what it's sitting at today. If I had a do-over, I would do it right now. Right now. I'm not kidding. I wouldn't even take a breath. And I think if you do, you're taking the risk. But that's my personal opinion. I wouldn't do it. I would go ahead and enter them right this second. And if I could do a do-over, I would. Because
this was the breathtaking bounce that I've been hoping we would get. So I'm not worried whatsoever, and really understanding what's coming up for the next 2 years is horrifying. And so for us to have a feeling of not being scared to the bone for a few weeks, I really don't mind that. Gave us all a lot more time to get our head straight, to get our portfolio positioned, to get our thinking process ready. And, we don't need to rush the stock crash and the depression now, do we? It's coming whether you like it or not. So that's really my best input on that. But great questions, Joe. Very good.
I appreciate
Yeah.
your input. You too, Karen. I think I'm going to jump in and take the plunge.
better, I may have to spank you.
Yeah, I'm going to plunge.
Yeah.
Great
no,
questions, Joe.
I'm not kidding. It's a fraction of what I got in at. So I would highly recommend you really follow that today. Because I've been watching.
It's half of what I got in at, or maybe less.
Yeah.
So
You'll be very happy you did today. So there you go. That just a sidebar, but that's
that was free, right?
that one's totally free.
Looks like Karen just pushed you in the pool, Joe.
She did. Yeah. She just shoved me right on in. Close and all.
That's
Too
right
funny.
in the deep end. I wasn't kidding. You better believe it. I mean, if I could make a recommendation for somebody to do better, then I'm gonna tell you, and I'm gonna be raising that flag, saying yes, do it now. So, there you
Ryan, let's unmute Tom Sharp, Perry Taylor, Murray, Mark Stoley, and Kathy Crickman next.
Yeah, they can all unmute.
Okay, great. If you guys are out there, I'd love to hear from you. Say hi. Haven't heard your voice in a little while. And Marlene as well, please. Go ahead.
Hey, Jason, this is Perry.
Hey, Perry, how you hanging in there?
Well, we're doing good.
Very
We're
good.
doing good. I was going to say on the last conversation, even if you jump in the deep end today, I'm assuming you would still want to do the dollar cost averaging next week when you maybe placed another trade.
Yeah. So dollar cost averaging would be like, I've got new money to follow the current plan, but your relative risk per position, percentage wise, is still the same, right?
Yep.
If I want to take the same money and increase risk, that's what I'm actually doing next week. But very good point, Perry.
Yeah, so that's you hadn't mentioned bringing up the strike price, but that's kind of exciting there. To know that we'll be able to have a strike price closer in as this thing turns around and goes the other way. But you're right, you don't want to miss it when it goes down.
Yeah, when you're trying to hit a 500 to 5,000% return that only happens once a decade, you don't want to be too greedy about timing. Now, I will say, for that entire crash, all I sat there and did was prayed that we would get. Literally, that's what I was telling myself. Wait for an unbelievable bounce, and there's your entry point. It just
Yeah.
didn't seem like they could muster that. They were throwing trillions, 2.2 trillion here, 4 trillion there. What really caused the bounce was all the people who were short took the profits, and all the people who had written those puts had to cover. And so we got a temporary bounce here. So the good news is we didn't go all in on a short, and we're going to double down next week. So again, I do want to point out it's different to dollar cost average, which is what Joe was talking about. He's got new money to put to work, so he can just lay it in as it's designed. Next week, we're going to change the risk profile. So our relative risk per dollar invested is going to increase. And we were very patient to make that move. And as you can see, we're still being very patient. Marlene, how's it going?
Hi, good, thank you. Yeah, SPY was really affordable yesterday because I bought in on Monday. So I'm almost at the break-even point, but a couple of questions. One, why are you waiting until next week to buy more puts? And two, I came in to the basic program with 30,000, and I know that you answered my question on
Oops.
Monday about what to do with 30, but moving forward, I'm wondering how you might address, if I don't, like other people have 75, but I only have 30, how will I know what to do exactly?
Sure. So yeah, so your job was to pick up are these the 3 you bought?
Yes.
Okay, good. So that gives you plenty of coverage for when we think we can buy stocks, which I believe will be sometime around August, September. So you had a bunch of questions. One, why am I waiting? So I do like to listen to really 2 more technical based people for timing help. One of which is a huge Japanese bank called Nomura.
Mm-hmm.
They're pretty good at predicting short-term technical based mechanisms, like when CTAs run out of money and will flip, or looking at momentum dying down, things of that nature. That's 1. 2, Trump's telling us he's going to open the economy up and roll out this plan. So I do think that can get some unwarranted boastful attention. So I do want to let all those plans go out and see if we can get one more pop before I layer in another tranche. And if it comes to Wednesday and I'm still not ready, I'll delay it another week. I've been telling you guys I was going to double down every week for 4 weeks, and we keep pushing it. What's happened? Our TLT stays steady, which is very good. And we're starting to see the momentum of stocks have to face reality with banks really scaring everybody this morning. We'll take a look at some of that news. So yeah, you'll have to, and I understand a lot of people are going to be in the same predicament. So I'll make it quite clear how to do this set of ETFs when the time comes for a $30,000 account instead of 75.
That would be terrific. Thank you so much.
But yeah, your game plan's the same. Leverage put up. So realize if you buy a put and you're right, it's essentially like having a huge amount of capital at the perfect time to rotate into stocks, because everybody else is going to be in pain. They're going to be suffering big losses. They're going to be fearful for their expenses for retirement, and they're going to be forced to liquidate. The cost of insurance at that time will be outrageous. And so it's going to play 2 important jobs. One, it's going to allow us to get into our ETFs, which again, we're going to start off by writing puts out of the money for a nice safe yield, not being greedy. And then eventually we'll rotate into owning these ETFs. And again, while everyone else is going to be going in and out of lockdown, it won't be clear what will be allowed to operate as a business and what will. These companies certainly will be operating at full capacity and probably making more money than they ever have in history, or at least making greater returns relative to their peers in the coming period of time. And that's really without question that healthcare, biotech, medical device, e-commerce are really set to jet. Now the Boeing play, ITA, is really expecting tensions with US, China, Russia, and also betting that our military budget will continue to grow year over year, as it always has. So if you do look in the purple line for ITA, it's already at a significant discount relative to its peers. So that'll really be our value play. These other companies will be our growth play. So that's really this will be bigger chunk of money generating steady return. This is a smaller chunk of money that's aimed at creating a much higher return. Now, if we're aiming for much higher returns, we don't want to bet the farm because things can go wrong and you can lose all of it. So that's why we're being careful and we're buying a lot of time premium so we don't have to have this hit at once. Pat, go ahead. Always love questions from Pat.
Or last, I guess Monday and you mentioned, hey, why don't you find out whether or not there are any information on whether people have the virus? And there's a new study that's coming out. They asked for volunteers for 10,000 volunteers to see what percentage of them, as a randomized study, have the virus already that haven't gone for testing or haven't shown signs. So
nice. I did see a headline this morning that Abbott's going to roll out antibody test Tuesday.
Yeah. The only thing that makes me nervous about the whole thing, which I think is great, is that we should get that information, hopefully get that information before the market does, because the market's going to react. I still think, I think even to that. So before I say this, I think today it doesn't even matter if tomorrow or on May 1st, the whole economy opens up. I think there's so much damage to the world's economy that none of that really matters. But the market will care. The market's going to care. And the market will react as if everything's back to normal, which will delay the approach that we have here, I think. And the other thing was, I think the NBA or the Major League Baseball is also doing that same test. So it would be that's not randomized. It's more like just a test. So those are I guess that was my last assignment. I'll keep looking for that stuff.
Very good. Yeah. So some members have been asking what they can do for extra research to help the whole crew. So I really appreciate that, Pat. Very good.
Yeah.
Very good. Murray, let's get Murray on there.
I'm here.
Hey, Murray, how's it going?
Good today. I'm still suffering from the early purchases of the SPY.
The put options.
Puts.
Yep.
Yeah.
Yep.
I can hardly wait for it to rebalance out to a profitable position, and I am tempted, like everybody else there, to buy the cheaper versions.
To increase your relative risk.
Yes.
Yep.
Right.
So I want to wait a little longer, but I do want to make the same move. So I feel ya. You get your Hong Kong trade on, Murray?
2 days for the approval.
Okay.
So I'm waiting on TD Ameritrade to. I opened the account, but then to get the Forex, I had to fill out a bunch of forms and wait 2 days, they said.
Oh, okay. Well, no rush, and then I can walk you through it on our boot camp webinar Thursday. Now, what about your Chinese put options? I bet you got those.
Yes.
Yeah, Murray likes to be on top of shorting those Chinese. Very good.
No, I think that's your idea of delisting companies that don't conform to the accounting standards that we require of American companies is something that Trump and a lot of people in the government should be considering and acting on.
It's a no-brainer, and we already see it coming up in Congress. We saw the Pentagon do a press release yesterday where I think it was actually, I don't think it was WAPA reporter.
I didn't quite catch that.
But they point blank asked the Pentagon leaders if they thought it came from the level 4 biolab in Wuhan. And they said it's classified under review. and they can't talk about it. In fact, I could probably play that clip for you guys in a little bit. Kathy C. And let's get James Goodman on there. I'd love to hear from everybody. Michael Seebeck, we're Facebook friends now, so he knows what I look like. How's it going, Mike? So he sees me ranting about the coronavirus to all the locals here.
Keeping us safe, Jason.
Jason, can you hear me?
Yes, sir.
Yeah. I'm just sitting back watching and listening, and actually I really look forward to the time that that we spend collectively as a group hearing about everything that's going on, and so I really enjoy this.
Oh, very good. And
Yeah.
your spreadsheet, the spreadsheets are working beautifully. I just want a little more time to make sure there's no programming errors, but I do intend to release those and get them out to everybody before Thursday.
Okay. And then as far as homework for this week, do you have a new set of homework?
Did you get the Tuesday videos? There's 5 really good ones.
I don't think
Let me pull it up. This is
received them.
the best video I have seen to date on
Yeah, Mike, your 30-day bootcamp trial, I think it expired. I think it was last Friday Thursday when we talked. That was the 30-day period.
Was it? Okay.
Well, I'll forward you a copy of it so you could check it out. This was critical to watch. Let me pull up the email we sent out yesterday with that.
That was an amazing video, actually.
Oh man, that guy's good, huh? He really nailed it. My 12-year-old probably knows more about this than half the country here, but he liked it too. This is a great video. The case against China. I've seen this guy a long time ago, and I think I've when I was studying the Wim Hof method of all things, I think that's where I ran into this guy. He was doing these cold baths. You put a bunch of ice in a bathtub and go freeze yourself for fun.
Mm-hmm.
Funny enough, which actually might be very good for fighting the current problem. But man, he nails it in this presentation. He just lays it out in a very succinct timeline. And you know what I've been saying? Who was the first to say China did this as an attack? I called that out literally weeks into this crisis. In fact, I
have you
think.
seen the video from Laowai 86?
Hey, Mark, how's it going, bud? Haven't heard your voice in a little while. Good to hear from you.
His article was on Zero Hedge.
Which one? Sorry, can you say that again?
Laowai 86. LAOWY 86. LAOWHY 86. And then he's got a YouTube channel. Yeah, that's it. So they talk about it, and then they make a reference to his video, and that one with she on there, that's his video, I think.
Okay, cool. I'll check it out. Yeah, I have, you guys want to see my watch list? I'll try to pull it up. It's just, it's hard to really understand what's going on. 1 year we're trying to study the Chinese history and government structure, which was last year. This year we're trying to understand something that the best scientists in the world don't have a clue how they work, which is viruses. I'll show you what I've got queued up for my watch list right now. I know a lot of you guys have been wanting me to watch the NTD video, so I have it up top. I like listening to these virology lectures. Let's be honest, they're a lot above my scientific knowledge, but you can pick up the key problems that we're trying to face here with this. And the more you study this, the more hopeless it is. And also that the case for vaccines becomes more troublesome because this does look like this virus has multiple avenues for destruction, not just that ACE2 receptor in the lungs. So I have a whole bunch of these virology lectures. These are true experts coming in with doctors on the scenes, virologists. Get through as much of that as I can. I gave you guys just this one-on-one to watch this week. But yeah, that video, Mike, that we just posted was just incredible. But yeah, I like to listen to Quoth the Raven just for a little bit of a comedy. This Dr. Paul Cottrell's been dead on. He puts out a lot of content though. MedCram is incredible. I don't typically send these to our boot camp studies, but I watch those daily. Now, a lot of these you can listen to and do other stuff, but when you're doing MedCram, you better put it on full screen and have zero distractions. I like to listen to Real Vision. Dr. Eric Berg will give you some sort of just easy health tips you can. And I also like to listen to Dr. John Campbell, and there's a lot more. Peak Prosperity is very good. But let me just pull up what I did release. So we gave you guys Tuesday, the case against China. Killer video. This was absolutely, and he touts himself as a philosophical blogger, not a financial anything. This was very revealing. Bill Gates, BBC, we know he funded the WHO. He wants to do a lot of things here, and I do think this will probably be the most predictive outcome of what happens, although Trump team is pitching something completely different than Gates, so we'll see what comes of that. And I will note there's a lot of people who are getting very upset about us having our economy shut down, which is interesting. And I'll take a look at some of that in a minute. We're getting to our 1 hour mark. Let me take a quick break to review our options for everybody listening, and then we'll go back to presentation. I have a lot to present, guys. We've got charts, we've got news, we've got history, we've got comparisons to the Great Depression, to the runaway inflation of the 70s, to the dot-com bubble, to the mortgage bubble. None of which are exactly the same of what we're facing today. So I'll try to put it all together for you in an easy to understand format. But Dean, do you want to review our different options real quick for new folks? I'll pull it up on the screen.
Sure. And just member-based, what do you guys think about that? I think it was, Jason and I kind of came up with the idea to fast track immediate questions to you all first, have you skip in front of the line, and we don't get the most intelligent questions from the trial members, to be completely honest. So we wanted to just kind of fast track you guys to the front of the line, get you that VIP access. Did that work for you, Mark, Michael? Was that better for you guys?
Yeah, it was fine.
Okay, cool. Awesome, guys. Well, we're going to continue that structure, and just that way you guys don't have to spend as much time. We know your time's valuable, right? Just like ours. So, okay, cool. So real quick, guys, Jason has on our screen the options that are available to you. And Jason, I'm not sure, do you know the exact number of spots that we have left in the boot camp? I know they're getting few and far between at this point.
I went from just me and Donald Dickey to a crew of about 40. So that's been really, really wonderful to see the growth of the boot camp.
Nice, very nice. Okay, guys. So on your screen, real quick, there's a couple options for you, and really it has to do with how much capital you have to replicate our trade positioning and engineering. Okay, so the first one is going to be the buy and hold portfolio. Okay, basically, guys, we're going to utilize ETFs only to be long or short specific asset classes. Okay, so pretty simple. If you have less than 30K, that's a great option for you. Okay, and instead of shorting the market with options, you're just going to use inverse ETFs. Okay, so if you have 30K, that's the best place to be. Now, if you have between 30 and 75K, the basic option is phenomenal. Okay, and as you saw today, you can see how to position into really intelligent time durations setup that Jason's had. Okay. And if you're just starting today, man, do you have a phenomenal entry point on those put options, okay? And that's a that portfolio will eventually own the S&P 500. Okay, it will probably own some ETFs before the S&P 500 is bottomed out. Okay, but just a really phenomenal way, guys, if you have between 30 and 75K to really grow your capital base or your foundation, as Jason refers to it, okay, in a huge way before, before we go back in and buy, okay? And I can't tell you guys how incredibly lucrative it is to be building wealth while the rest of the world is decimating their wealth, okay? And so all of these portfolios are going to give you the ability to do that, but the basic portfolio specifically is perfect between 30 and 75K, okay? Now, the Pro portfolio is used and loved by anyone that has 75,000 as a minimum or much more, okay? And we literally have people that are using this portfolio with excess of $4 million that don't even come to the webinars. they just replicate the trades. Pretty funny. But guys, it's just, if you have more than 75K, this is a phenomenal opportunity for you to truly understand, what's going on in the market. And if you get into the basic option or the Pro portfolio option, we do give you 30 days of the boot camp completely for free. Okay. And that's limited by the number of spots. We don't know exactly when those spots will go away, but when we don't have the spots, we don't have the spots, and we will not have that bonus. So if you were thinking about it, your expiration is going to hit today, tomorrow, the next day. Take advantage of that, guys, before those spots are gone. They absolutely will be gone before the end of the week. Okay. And so that fluctuates too, guys. We don't know, exactly when we're going to have those spots or not. We do give 30 days as a bonus until we don't have those opportunities. Okay. So just a quick heads up on that. And the boot camp for lifetime. Okay. If you're newer to the markets, you have a couple $100,000 you're looking to put to work. Maybe you're out of a job for the first time, but you've been smart, you've saved your money, and you maybe have something on the sidelines. That's a phenomenal way to understand, to think how we think, okay, to truly understand how the financial system works, okay. And the really cool thing with the boot camp is you actually get a free year of the Pro, and you'll have access to the boot camp education for the rest of your life. So a couple of really cool things for you guys to take advantage of. And if anyone has any questions about that, happy to answer them now. I know Anmai was asking about the Pro. And yeah, and I certainly, we don't know if we'll have those spots down the road. So I would encourage you to take advantage of them before they're gone. Okay. Any other questions on that real quick before we keep going?
Very good. Thanks, Dean. And so, yeah, we have the chat box to ask questions, and then we also have the audio box. So if anybody does have questions, please go ahead. And we do have a lot more content to cover. So let's see. I do see a few questions popping in here related to trades. Didi says, is this recorded? Yes, it is. So just go right back to your trade alert and click the link and it'll automatically replay for you. Logan says, Stephen Von Mitri is a YouTube analyst who's spot on, claims TLT is going to 250, gold and Bitcoin will fall, then skyrocket. The market will break new lows. He's literally saying identical things you do and explains it. It's amazing. I suggest you check him out. Oh, cool. And that is exactly what I'm saying, although I am not familiar with him. Jim Wills says employment report on Thursday. Any thoughts to share? I bet it will be ugly. And again, I think of the Fed, showing off its muscles, seeing how high it could throw a baseball, but to no luck, it just comes right back down because gravity. And that's what I believe we'll see with stock market and economic data. Economic data is your gravity and stock market's your baseball. Gary Barber says, what's the link to the video mentioned earlier? Oh, he found it. Okay, good. Sue L says, are you waiting to add SPY puts next week? I assume that you're waiting for the SPY to go up more. How high are you expecting SPY will go? So yeah, my basic, if you guys have ever read the book A Random Walk, there's always going to be someone who's going bankrupt that you didn't anticipate, liquidating when you didn't anticipate. There's also going to be big buyers who go into an illiquid market that no one wants to buy and pump it up for perhaps political reasons, perhaps to let insiders out. So day to day, I do believe it's quite a random walk in the markets. What is easier to predict is, again, that analogy that gravity eventually wins. So yeah, I think it's prudent to delay increasing our risk. I don't think it's prudent to build positions with new capital. So we already have the right risk profile with our portfolio to be situated quite handsomely if there's a downturn today. But if this lingers on for another week or two, I'm giving time as the best instrument for risk management. So I'm letting time play out because what's on my side, time is on my side when we have a logarithmic growth in deaths is really the best leading indicator. So a lot of people are trying to look at new cases as a best indicator, but they're still telling people they can't get tested if they don't have a whole bunch of criteria. So we really might just be seeing the limits of testing with that measurement. If this keeps up right here, we'll be having a hard time just testing all the dead people, much less trying to test the population, the workforce, the military. Now the military is fighting over who to test. In fact, in the Pentagon speech yesterday, he spent quite a bit of time saying it's going to take him 45 days to have the right protocols in place to be able to mobilize the military. Because right now, if they mobilize military, that it would be a huge risk of spreading the virus and taking out our forces just from our own inability to test and control. So I really think the antibody test will probably be the next big, decent piece of news in our favor, but it won't really change my outlook, unfortunately. So let's see, that answers those questions. Any other questions? I do have a lot more content to go through here.
I think Kathy's got a question, I think.
Okay, go ahead, Kathy.
I couldn't get the mute off of the phone, so I switched over to the PC. So on the Pro membership, I just want to make sure I'm keeping enough money ready.
Yep.
I should have about half of that 75,000 in cash, correct?
That's about right. Yep.
Okay. That was it. Thanks.
Jason,
Yep,
this is
pretty.
Mark. I have a question.
Hey, Mark, how's it going?
All right. So with all the Fed's actions, and I'm seeing article after article on zero hedge, how it's no longer a free market, and it's basically it's the Fed market. And I mean, just recently there's an article, investing giants Gunleck, Alarian, Mark slam the Feds, take over the markets. They're basically saying we're not following traditional investing anymore. We're just doing whatever the Fed does. And so I'm wondering, are we underestimating the Fed's manipulation of the market and the direction it plans on taking the market?
Good question, and I'll tell you the answer is no, and I'll show you why.
Okay.
So yeah, I do love Jeffrey Gunleck. I'll read you two of his quotes from yesterday. Of course, the Federal Reserve will make some wonky semantic argument about why they're technically in compliance, just like the balance sheet expansion program last fall was not QE. The Federal Reserve is presently acting in blatant non-compliance with the Federal Reserve Act of 1913. An institution violating these rules of its own charter is de facto admitting that said institution has failed and is fundamentally broken. So what's the risk if the Fed prints too much money? I guess that's really the question. What's going to stop this? So here's the Fed's balance sheet. Look at that, just going straight up, straight up. So yeah, if they print too much money, we risk our best asset, the value of the dollar. So they're playing a careful line of trying to keep stabilization in the labor market which is really what your 2.2 trillion stimulus plan is. That's what we're going to see goes directly into our TLT in terms of assets under management. Then we're seeing all the credit lines that the Fed's directly opening, which are really just open lines of credit to the dollar to central banks, where they're trading currencies. But what do you think the Fed would? What do you think the Treasury would do if other countries started printing money faster than us? And we hold a lot of their currency. My bet is that the US, if it saw other central banks printing too much of competitive currency in response to what we're doing, which is printing too many dollars, I bet you they're going to start dumping those currencies, which make the dollar strengthen. And what happens when the dollar strengthens? Then everybody short dollars starts selling stocks for liquidity needs. So yeah, my expectation, Mark, is that the balance sheet growth is going to dramatically slow down in the coming weeks and months. And then that will be lined up perfectly with the government slinging that huge tranche of debt and trying to get interest rates lower to finance this crisis. But yeah, you're right. If they just kept printing trillions of dollars a week, let's just look at that really quick. And by the way, they have been every week reducing the Treasury purchases. So that's exactly, so they're trying to stabilize markets, but they really need people to buy treasuries because we have to issue so much debt.
Doesn't that put us on the wrong side of the market until then?
No, so quantitative easing makes stocks go up. It is protecting the TLT from going down right now, but more so it's protecting the stock market from just absolutely cratering. So yeah, let's look at that. QE tends to be very bullish for stocks, but at the same time, obviously protects the bond market. So if they wanted to force investors into bonds, all they have to do is cut off the QE, and then investors have to choose. Do I bet stocks will go up because of profits and earnings without the assistance of the Fed? Or do I think yields are going to drop because of low growth? So I think that'll be pretty easy. So this is one item I love to watch. And let's see what date we have here. So this is a report the Fed puts out every Thursday. So we'll get a new one tomorrow at the close. So this is April 9th. This one is April 2nd. And this one's March 26th. And the easiest way to, it is interesting to see what they're buying and selling, but we know what they're buying. They're buying all aspects of the Treasury curve, and they're buying mortgage-backed securities. So now the Fed's the biggest landlord in the world. And what do they, why do they get to be the biggest landlord in the world? That's, anyway, 500 billion. So they added $500 billion to keep the stock market from just absolutely cratering. Then they added $600 billion, so $0.6 trillion the next week. Then they added $393 billion, so $0.4 trillion to keep the market open. Pretty expensive stock market to keep alive, huh? And so that's our last three prints. We could go back, but really the most of the growth of the balance sheet, which we can see in this image right here. We went from, and really this, let me try to zoom in on the, so there you go. You went from 4.3 trillion to 6 trillion in a month. So I expect that there would be repercussions if they continue to print, which would be a loss of faith in the dollar, which would have two implications. Either people lose faith in US products because they know the underlying asset, the dollar, is losing value from devaluation, or they in turn start printing as fast as we do. And you got to remember, the US has these exchanges with all these different currency markets. So if we think they're printing at a rate that's not fair, well, we're just going to start dumping their currency, which brings us right back to probably the most important indicator is the strength of the dollar. And so dollars gaining strength once again, despite everything possible to devalue the currency. Cut rates to zero, bail out everybody, give out free dollars to the world, and the dollar's strengthening. So yeah, I think it's just pretty set in stone. What's going to happen is companies are going to struggle. There's just no way around that. And governments are going to blow out deficits. And so really that's the perfect recipe for our strategy here. But yeah, I agree with you, Mark, that this is impressive. But I don't think it's sustainable. They can't print $500 billion a week forever. And so this, as they slowly draw this down, and I do expect you'll see an even lower print this Thursday, that the whole play the balance sheet of the Fed strategy loses steam quite quickly.
Because the drawdown has been a bit painful.
Yeah, I agree.
That has been manipulating the market.
Now, do you have the same risk profile and allocation I do, or are you more?
I had more on.
More on. Well, it looked like there, it looked like there wasn't going to be a recovery. So I understand why you did a little extra. And the first day we put it on, we're starting to see profits in these out of the money puts, and then they came in with massive stimulus. But yeah, they risk a currency war playing out if we just print endlessly. So that's what I expect is you'll see that they want to not allow the banks to keep cashing out these treasuries. They really want the big banks to buy and hold treasuries, raise all the money, fix the underlying problem, and then cash them out. And that's really what's happened every single time in history that if fiascos come underway. So this is a good chart to look at. This is the federal funds rate. The gray bars are your recessions, which correlate to stock market crashes. In every single crash, the Fed was not stupid. They saw the crash coming. They saw the problems coming. And what did they do? They cut rates to significantly lower. And that in itself creates a mechanism that incentivizes buying US Treasury products. So we've gone over the formula, but basically big banks borrow from the Fed, and they buy bonds from the government for a profit with the yield, which is low, but they don't buy it for the yield. They buy it because they know if they hold it long enough, the Fed will come in and scoop those up at a lower yield, higher bond value for a profit. And so anytime we run into economic trouble, this exact same thing is played out like clockwork. Bonds go up, stocks go down. And I don't believe, quite frankly, the biggest disruption to the economy in history will play out any differently. Yeah. And again, the value of the stock markets, upwards of $28 trillion just in the US. Add in global markets. Well, this print right here of $1.5 trillion has to protect real estate markets. Plus it has to protect the debt market. Plus it's trying to protect the US stock market. So unless they plan to grow this to 10, 20, 30 trillion dollars, I don't anticipate the stock market being able to stay above water. And if they did do that, it would cause a lot of knock-on effects, which would most likely result in other countries devaluing their currency to keep up with the competitive edge that we're giving ourselves. Imagine that you own products denominated in dollars as an investor, and all of a sudden the Fed drops rates to zero and starts printing funny money at the fastest pace in history. Probably going to start wondering about what's the real value of that asset. So yeah, we're fighting the Fed. Very good question, very good concern. But unless they wanted to go to extreme measures, I don't think $500 billion a week is going to cut it. And I don't think that the repercussions of doing that for too long would be something that the Fed's willing to do. And so we'll closely watch that, obviously, to see this drop. But we already have seen it start to fizzle out last week. We'll see what the addition is tomorrow. And again, every Friday, the Fed's been tapering down their bond purchases, which is essentially telling the market that the balance sheet growth is going to slow down. So if you're trying to invest in the stock market based on the balance sheet, well, that trend is going to slow down considerably. See, any other questions out there? I do have a lot of other content to go through. So any new folks out there with questions? I think we got a big crowd, so don't be shy if you want to
Old
talk.
person with a question.
Go ahead, Karen.
Okay, I'm sorry, I had an interruption. A girlfriend of mine just called me from Nashville. Her license plate was stolen from her place she works at Amazon, just so you know. And
wow.
yeah, so, well, they're stealing cars. So that's what they do. They steal license plates. So just everybody be aware of what's going on. I saw that 40 years ago, by the way, in Miami. It happened to me. I didn't hear the whole thing because I'm sorry, I got that interruption. But when you said we're fighting the Fed, that concerns me. Is there a time in history where you could fight the Fed and it worked?
Okay, so yeah, the point was that the Fed can only print so much money before the world, who has, we borrow a lot from the world.
Right.
Okay, so people who hold US debt, stocks, real estate, dollars are going to be very upset if you keep rates low and do this for too long.
Mm-hmm.
So they're going to run out of, my expectation is that they will not continue to grow the balance sheet at this rate, and that would be devastating for stocks and help them achieve the goal of pushing the bond bubble up. But yeah, if they keep printing at this pace, it will be a loss of faith in the US dollar, which again would result in people liquidating anything associated to the dollar, including stocks. So yeah, I don't think there is an option that saves the stock market outside of shutting it down and just locking it where it is. There you go.
Okay, because I was watching this morning. I saw that woman who's the head of the IMF. And of course, right now, they need us and they want our dollar and our economy to be strong, et cetera, because of the rest of them. And she was kind of throwing everything out there, saying, we're the old Star Trekism, the old Scotty, we're giving it all we got. So it's interesting. But then I go back and I try to remember back in the 80s with stagflation, et cetera, where things, also got, it's just so difficult. Everything's a little different. And at the same time, there's some similarities. So
here's the big picture, guys. There's about $100 trillion of assets around the world denominated and associated to the dollar.
Right.
But there's only, prior to this, 4 trillion real dollars. So if you get a tiny percentage of people trying to liquidate at the same time, there's not enough dollars to cover it. And that's why we got the first little leg down.
Mm-hmm.
So yeah.
Okay. Thanks.
Okay, let me go through some more charts. Let's start off with the news, then we'll go to charts. How's that sound? Okay, so China's suspending the testing of the remdesivir. Curious why they're claiming it's because there's not enough cases that warrant it, although this is also a day after we've cut funding to the WHO. Bank of America profit plunges 45%, as all the banks are now hoarding cash, expecting delinquencies in mortgages. Second wave of coronavirus layoff, claiming workers who thought they were safe. So yeah, corporations are not stupid. They don't want to just employ people that will never work again. Many corporations are having to redraw their entire business plan, cut costs, cut investments, cut corporate buybacks, cut debt, cut employees, and focus on what works. That's really going to be the big trend of corporations that will survive this. And just trying to stay with exactly how you were 6 months ago is not going to work. So government's trying to do its best to keep companies in place when things are turned back on. Retail sales crashed by the most ever in March, despite hoarding. So everybody's went and hoarded everything they need to hoard. So I think any sort of retail bounce will be dismal moving forward. China will be hit with the second coronavirus wave in November, top Shanghai clinical experts warn. And so you guys heard it first here, right? I said 60-day lockdown, reemerge with masks. We'll see if we get the lockdown. If not, it really helps us, not hurts us. But they are now getting everybody to wear masks. That helps, but it doesn't stop the problem. It could just slow it down and make it manageable. No matter how you skin this cat, economic output is going to be greatly reduced. Unemployment's going to be much higher, and government deficits are going to be blowing out of proportion. So the big picture outlook just is impossible to change. That's why we've been able to not change our outlook this entire time. And we're sitting on a 168 TLT. So we haven't even budged a moment. Here comes the depression. Empire State Manufacturing crashes most in history. Senator Hawley announces a bill to hold the Chinese Communist Party responsible for the virus pandemic, using the US rule of law against lies. So there's a lot of treaties in which China is supposed to alert everyone when something like this happens, and they didn't. So they did break some laws that can be held accountable. So again, almost without question, the pain, the enemy will be pointed at China, and we'll be restricting capital flow. So I really like that FXI put option trade, as well as our Hong Kong trade for the boot campers. They could happen at once, or they could happen one and then the other. But they are correlated. One has a potential 30-to-1 return, the FXI trade. The Hong Kong trade has a potential 100-to-1 trade. And we have about 1% risk in each position, a little bit over. So that's the right amount of risk for such a play. But if you get those returns, it's really the play of your lifetime and what will make your entire 2020, 2021 extremely beneficial with low risk. Now we've got a lot of different trading opportunities, so we're having to be careful and control how much risk we put into each trade because we want to be spread out. Kyle Bass is your Hong Kong expert, at least in terms of trying to predict doom and gloom for it. Carrie Lam talking like this: Hong Kongers need to prepare for a full Article 23 implementation. This with Liu Huning's Butcher of Tibet comments posted to the ministry website last weekend tells me Beijing is about to flatten Hong Kong. Chief Executive Carrie Lam warns of multiple threats to national security in Hong Kong, from extremist actions close to terrorism to cold-blooded and hate speech. Jane Bianco: only a handful of companies, mainly banks, have reported Q1 earnings. Too early to proclaim a trend, an observation. Analysts cut forecasts by record, and these reports are far worse than expected. Tripping on the starting line and face planting is not a good way to start. Have cases really peaked or just testing? And I'm actually going to think that the antibody test is far more interesting than the active test, although there is quite a bit of evidence mounting that one, that test is not accurate. Two, people are becoming reinfected. Three, it's only testing one specific way the virus gets you, but it does look like this virus could get you from a multitude of avenues, different cell receptors. So they're still slowly piecing this together, and it may have lifelong repercussions if you catch it, not just a one-time cold. Okay, I like to listen to Chinese propaganda. At the dangerous time of a pandemic, President Trump suspended the WHO funds out of political purpose. This should be condemned. WHO is the only organization that coordinates antivirus fight among countries. Washington is undermining humanity's effort to defeat COVID-19. What a joke. Tale of markets. The New York FANG index is now up on the air, led by Amazon. S&P is down 12%. I will point out Amazon's not going to be having record profits and earnings with a third of the population unemployed. So everybody went and blew every penny they have in fear, and now they're broke, unemployed, and going into saving mode. Very deflationary move coming up is what I think is coming underway. Now we might see some food inflation, things of that nature, but in general, this appears to be much more of a deflationary shock.
I think we're going to see crime inflation and food inflation, especially when you get that pork plant that you're shutting down.
Oh yeah, Mark, it's going to be bad. It could get really ugly. The Fed caused a multiple expansion chase on flat earnings growth in 2019, and now the Fed is again producing another multiple expansion chase on negative earnings growth in 2020. The Fed keeps claiming to do the right thing for the economy. All it does is cause distortions. When will the Fed team up with Apple and Google to make an app that tracks the location of short sellers so they can be sent to re-education camps? Oh, absolutely hilarious. And that's referring to the Chinese Uyghur camps. Okay, Gunlex, sick to his stomach. Next thing they'll do is go to negative rates and he'll really lose it. Gunlex, a hero of mine. I don't necessarily take the same trades as he does, but I respect every word that comes out of his mouth. Massive purchases of treasuries over the past month by the Federal Reserve, but yields not plummeting. Since late February, 326 billion has exited bond mutual funds, ETFs, margin calls. Trump, Kumho's.
Hey, Jason, sorry to keep interrupting. Can you back up just a little bit? Is that something that maybe we should be tracking a little bit closer? That wouldn't that kind of let us know which way the TLT is going?
My analysis is really earnings growth. I want to be long stocks. Debt growth. I want to be long bonds. That's really, really the big picture there. So I think we could chalk up that to rebalancing and margin calls. Same thing we saw with the when we didn't sell our TLT in time, but we got it right that the market was going to keep crashing. But yeah, you can see that quite some selling of all assets during the crash. Office vacancies in China's top cities surged, hit record high as market demand was hurt by the outbreak. Every country will suffer economically this year, but I believe this fall of Chinese economy will be slower than that of the US, not just because China is the earliest to contain the spread. It also is more capable of balancing and restarting its economy. Wells Fargo reports 1 cent profit after loan loss provision soars to $4 billion. JP Morgan profit plunges to 7-year low on $6.8 billion in loan loss reserves as Diamond warns of severe recession. Following the balance sheet of JP Morgan is never a bad idea. I tell you what they've been loading up on well before this incident, and that's U.S. Treasuries. U.S. import-export prices plummet in March as COVID deflationary drag strikes. Again, if you're betting huge on gold, you might be quite early. We like that they're devaluing the currencies, but the immediate reason they're doing that is because of this demand shock. So it could take some time to get employment back, to get the economy rolling, to get all this money circulating through the system. and then start creating inflationary pressures, which again would cause the Fed to do what? To hike interest rates, which again is what I believe they will do as the big blow to the world at the right time, is to hike interest rates and weaponize the US dollar. So gold's a tricky asset. There's big spikes, you want to catch it, and then you want to get out of the way. So I think as we start to see all this money flow through, as the debt is raised, as it's handed back out to through the government and works its way through the system, as we get everybody back to work, then we get the inflationary gold run up. So I do think we're in the early stages in gold, but not the best stages, probably a year or two out. Luke Groman, what's the statute of limitations on the 2.9 trillion the Fed temporarily put on the balance sheet from 2008 to 2014 that never got quantitatively tightened off their balance sheet before we can refer to that 2.9 trillion as having been monetized without being chided by economic economists? So they always say that the balance sheet expansion is temporary and that they're going to pull it right back, but it hardly ever does. In fact, they tried to do that and we got a stock crash. So you can see they tried to tighten up monetary policy, raise interest rates when we did the corporate tax cuts, and the stock market was roaring higher. But the second they did that, first Bitcoin crashed, then emerging markets crashed, yields spiked, and then eventually the yields took out the stock market. And that's what we call the Christmas massacre, and that's when this program actually started publishing. It's the perfect storm. SoftBank reports staggering $25 billion Q1 loss. Ooh, these private equity firms are so screwed. Super leveraged business models that were completely built in sands of castle. And I've got bad hope for SoftBank. At least 250,000 Chinese landed in the US from that fateful day until the POTUS demanded a travel ban. The sinister virus has already been knowingly unleashed to every continent by then. Secretary Xi made sure if China was going down, the rest of the world was going down with him. Secretary Xi locked down travel from Wuhan to anyone else in China on January 23rd, but continued to encourage travel to the rest of the world. Xi and the deadly CCP knowingly infected the rest of the world with the virus. Chinese propaganda, COVID-19 is a major test for the whole world. For China, it was like a closed book exam. But for Europe and the US, it's an open book exam. The US government has handed its paper even later than European countries, but still blew the exam. Washington is rather stupid. Oh boy, I bet that's going to go over well. So just to summarize, fundamentals don't matter. The Treasury has our back. Liquidity supersedes economics. There's no accountability for having put money into largely crappy credit. Likewise, no reward for having avoided it. And we're already at the bottom. Got it. So, you can argue that the Fed made the right decision. When you're in a crisis of this magnitude, you really don't have time to try to distinguish who's a good company, who's a bad company. So I definitely think the short-term move they did made sense. They wanted to stabilize markets, give us some time. They can't keep printing money at this pace without everyone ditching the dollar, which would mean dumping everything associated to the dollar. So they can only devalue and really steal wealth from the world to some extent before everyone either does one of two things. Really, the option for other countries is you print money, I print money. If that happens, US will probably dump their reserve currencies. Also turns into a stock crash. Or the alternative, the countries don't print money and they start selling assets denominated in dollars because they know they're losing the value because of the Fed's actions. So the Fed has to be careful. They can't just print unlimited without consequence. Is the Fed broke? Hidden in the recent 2.2 trillion Congress rescue bill was buried 425 billion for the Fed. The Fed has been bailing out the world since 2008. Who bails out the Fed? Now we know. We are. Why? The Fed and Treasury hiding this from us? More, he says, buy more gold and silver and Bitcoin. We're screwed, but I do think he's quite early. Follow the money. The big money's going to one place and one place only, and that is government debt. So yeah, I did hear a little bit more about that half a $500 billion. They're worried the banks wouldn't do their job if they couldn't give out handsome bonuses and salaries. So I believe that's what that was tied to, was funneling money to the banks for bonuses. Not fair. For the first time in history, federal government is going to pay non-working Americans more than working Americans. So creating all sorts of problems. Now nobody wants to work, nobody wants to spend money, and nobody has a job. And even if they could have a job, they don't want it. That won't last for very long. The real Kiyosaki, this is, I believe this is the Rich Dad, Poor Dad fellow. Please be aware, we all know 50% of Americans have less than $400. Money is gone. 2.2 trillion stimulus will not be enough. Millions going broke, civil unrest to begin, army and police in position to protect us from our friends and neighbors. Very sad. May God have mercy on us. That's quite enlightening and very scary and true. Nearly 2 million struggling homeowners apply for assistance as forbearance explosion paints dire picture. The speed with which so much of America has gone from don't tread on me to indefinite nationwide house arrest for everyone sounds like a plan without a peep of protest has been remarkable and disheartening sight. Now, a lot of people want to open up the economy and get back to work, and they think this is a big hoax, which has been used to print money, hand it out to the rich, and do it when everybody's not looking. So I think part of that's true, but I do think the pandemic is a real threat. And even if you let everybody go back to work, I'm quite certain you would end up with the same result. People would be dying. No one would feel safe. Everybody would be upset at the government. Hospitals would be overran. And people would just isolate all on their own. So I do think that there's really no easy solution to the problem. Bill Gates' Instagram page flooded with people calling for his arrest for crimes against humanity. It's kind of sad to see Amazon near all-time highs as small businesses are forced to shut, likely forever for many. China quietly reimposes restrictions on movement as outbreak's second wave looms. COVID-19 chaos, perfect cover for mandatory biometric ID. My favorite part of this pandemic is people who live in population densities of 25,000 per square mile, scolding people who live in a population density of 25 per square mile. So year 2024, we still haven't left our houses because of the coronavirus. The S&P 500 is down to the S&P 1 because every company is out of business except for Amazon. We get $250 a month from the Fed in Amazon gift cards to buy necessities, all manufactured by Amazon. And meanwhile, they are leaking plans to open the economy. That will be something else. It'll probably be a phase 1, phase 2, phase 20 strategy that slowly but surely tries to accomplish this. Will we let the kids go back to school after the summer break? Big question there. At some point you have to. Okay, so I'm gonna, let's see. So we're 2 days caught up on that. Let's take a look at some indicators that can give us some idea of what's going on. So I've got 3 logarithmic scales. One's the total death toll. This is on a log scale. So again, it's 10, 100, 1,000, 10,000, 100,000. This is, I think, the most accurate counter. Are they going to count some deaths that may have not been related? Sure. We just saw a 4,000 jump from New York where they just went and counted everybody who could have possibly been a case. But on the other hand, there's in the last week, 1,000 people found dead on the streets or in their homes in New York, which is 8 times greater than a year ago. There's a lot of evidence that this has been spreading much longer than anyone anticipates. So with that, there could be a lot of deaths that were never tested, not even thought of being tested. And there's probably quite a few being missed currently. So why would you go to the hospital if you're not sure if you have it? Because then you know you'll definitely get it there. And then 2, people are still having a hard time getting tested. Unless you have the perfect criteria, they're not going to test you right now. So I do want to see this slow down to believe that we're taking the right precautions. Now, the right precautions result in our payday for our trading plan, because the right precautions end up killing the economy. So I'd actually say the faster this goes up, the less of a stock market crash we'll have. But no matter how you skin it, people are going to be scared to go out. Economic output's going to be reduced. Many companies are going to fail. Debt at the government level is going to explode. And that's really just simple as it gets for understanding the big picture here. Okay, but what about in the US? What if the US can get their act together? We know the poorer countries are not going to do lockdowns. There's no way. So I do expect this is going to go straight up for a long time at a logarithmic level. Now that may not necessarily be the best indicator for buying a bottom, or at least a short-term bottom in stocks, but it does have a good indicator when we can have international travel, because if this doesn't slow down, it means it's spreading rapidly worldwide. Okay, but what about in the US? Any hope? Well, and again, I'm less interested in active cases. I do understand this could give us a heads up to when we might see this flatten. But again, it's just so hard to get tested. A lot of people don't even want to get tested. They just want to sit it out, stay at home, avoid the crowds. Okay, so we're on the linear scale. Let's go to logarithmic scale. US is still growing at an exponential rate. Its death count. Now, we haven't had a real lockdown yet. We've had a semi-lockdown. So I expect a slower exponential growth, but not a flattening of the so-called exponential curve. So unfortunately, the measurements we've taken so far, I don't think are enough. And if they really do push the economy open early, that's one reason I've been waiting to add risk to our puts, because I think we might get another unwarranted round of market manipulation before we realize that that was a very, very bad idea. Now, I do think the bean counters are quite smart, who are advising the health team that they've been slowly tiptoeing us to a much more severe lockdown so that they could get the right infrastructure in place to cope with it and to reopen the economy after we really do kill the active case count. So if we can get this just really destroyed, then we could potentially open the economy for a while with a lot more precautions at a limited capacity. So that's something I'm watching, although it still does not change my outlook of how to play the markets in any way, shape, or form, at least for the next 4 months. Singapore. It's really hot in Singapore. It's really isolated and it's really rich. In fact, they're finding this thing lives in extreme temperatures. It's extremely hard to kill. So cases in Singapore are growing exponentially. Deaths in Singapore, although there's not many, are also growing exponentially. So the whole hope that we might see this. Let's see, we got some comments. Maybe those deaths that they think were from vaping may have been from Crohn. Yeah, possibly. So Singapore is really one hopeful place. If they could control this, that would, maybe we get a reprieve through warmer months like you do with the flu. But it's already very hot and really no case from that argument. The other hope I had is that maybe if we have at some point in time, what is it, 1 million cases right now, 1.5 million? Well, then maybe we've already got 15 or 150 million, maybe 10 to 100 times the amount of active cases have already had it and already have antibodies. So that's one silver lining on the, here's some good news for you. Maybe not right now, but in terms of reducing the timeline. Because previously we're all assuming that this broke out in December in China and then made its way into US in January. But now the timeline looks like this was growing in China for months. And it really just became apparent and too hard to hide early December. And that we've seen this growing as early as November in the US, which could indicate that a greater percentage of populations already had it and already could go back to work. But that does become convoluted once again, once you realize that people are getting sick, that this could have multiple avenues to attack your cells besides the ACE2 receptors, which are prevalent in the lungs. Now they're talking about attacking your T cells, all kinds of different bad news is coming out as we learn more about the virus. So those are really the three things I'm looking at is the death. With Singapore, it's so small. I'm pretty happy looking at the active cases because there's more data. With the US, I'm primarily interested in total death. And then with the worldwide. So this could give us an indicator of when we might actually be close to a moment of opening back up the US economy, which to some degree would be good for US stocks if they're revalued much lower. This will give us an indication as to when world international commerce can go back to normal. If you got 100 million poor people running around sick, then you're just not going to have international travel and commerce at full scale. So those three, and then for hope of a summer reprieve, then Singapore is really a good look at that. And so far, there's really no reason to believe that this can be managed from heat. Okay, let's look at some charts. And first of all, any questions or comments out there before we continue? Roth and Jack Tan have their hands raised. Please go ahead.
Hi, Jason.
Hey, Jack, how's it going?
Good, good. I was, when you were talking about Singapore, because I know the weather there, I used to live there, and also I'm from Indonesia. So the part that is very confusing is basically that in Indonesia is one of the fourth populated country in the world, where they live stacked after another, and especially if you're living in the capital city of Jakarta. In a surrounding is about almost 27 million people there living there. And having, since I've been talking to my family and friends over there, it seems like, yes, they have a spreading, but it's not really that bad compared to New York. I was assuming that they would be worse than New York because, when you're talking about weather over there, it's humid and hot and raining all the time.
So, and it's a huge population as well, yeah.
Yeah. And then, when I talk to my friend, they are more concerned about me compared to them. So they are not really they're not really felt like, and then I asked them, do you know anybody that is infected? No, he goes like that. And then I have a lot of friends that own factories there. So it's close to Jakarta. And some of them employ like 400 people in a factory. And I asked them, "Are you scared?" "Yes, we are scared." "But is your factory closed?" "No, my factory didn't close." And said, "Do you have heard any of one of your employee get sick?" "No." He said, "No, I haven't. Thanks God." He goes like that. And he goes, my employee when they're sick, they have to come to me because they don't have money. I have to give them the money. So I should know pretty much.
Let's check back on Indonesia in a month. I guarantee you their tune will have changed.
Really?
But yeah, I think the poorer the country, they're going to be less likely to test, less likely to lock down, and more likely to look the other way because they don't have the finances to do what America's doing. Yeah, they're just too poor. So what did U.S. do? U.S. just stole. Think about it. How did the U.S. pay for what we just did? We just stole $1.5 trillion from anyone and everyone who holds any U.S. asset. We just devalued our currency to pay for everything. And our country is lucky that a lot of our debt is owned by foreigners. So we basically stole $1 trillion from foreigners and handed it to ourselves to deal with this. Now, can Indonesia do that? No, no one has Indonesian debt. So yeah, they're gonna look the other way. They're not gonna test, and they're gonna have to let it just rip.
What my point is that I would assume that Indonesia would be a lot worse than United States because based on their condition, especially the hospitalization. The hospital there is really not equipped with anything, But but it seems like everybody is calm. They don't. They hear only once here and once there. But
Well, there's
not
probably a
really.
lot less international travel between the Chinese and the Indonesians compared to perhaps New York City, a financial hub, and then China.
I would say no. I don't think so because there's a lot of investment from China to Indonesia. So
Well, let's do this, Jack. Let's look in a month and see how Indonesia's looking. Okay.
Okay. All right. Uh-huh.
Good observation. I appreciate that. Roth, please. And you will have to hit your unmute button. I also have a lot of extra content to go through too. So we'll see how long we can keep you guys on here. Okay, looks like he did. Does anybody else want to raise their hand and talk? Okay, let's see, we got one in there. Ross, okay, go ahead, Ross, please. And Sean. Go ahead, Sean. You have your microphone open, and Ross, you can go next.
Okay. Can you hear me? Yeah.
Yes, sir.
Yeah. Okay. I think I would tend to agree with the Indonesian guy that in Singapore or Hong Kong, where I am at the moment, we tend to be less emotional about the coronavirus. Okay, I know it's scary and it's killing lots of people in America. The number of people that's been killed, dying, right? I'm not really sure that the attitude was as frightening as you would put it. It's like, did you take proper precautions? Did you, when you're supposed to be socially separated as much as possible, did you go and, where was it any problems for you to go to see a doctor? And did you, it's all about like how often you put on your mask. Did you take it seriously? Were you fooling around? And that's why you got sick. And then you didn't know that you need to go and see a doctor so that you can actually survive
So to me, that sounds like a cigarette smoker running around dancing, saying, "I haven't got cancer yet." Let's put it into perspective, guys. We have 7 billion people. we're seeing, even with extremely healthy people on naval ships that work for the military, I'm going to guess that about half the population is at risk of catching this. Okay. So let's put that at 0.5. So we're going to say that equals, I'm just going to do it in millions. So we have 7,000 million. 0.5 times that. Okay. So we have, and that's, so we have 3.5 billion people at risk. Now, what we're also learning is that only about a third, maybe it's half, but let's just say a third of those are actually going to have symptoms. So 2/3 of the people, no symptoms. They don't even know they caught it. Okay, that's what's so sneaky about this. Show signs. So we're going to say this is equals 0.33 times that. Okay, now the folks who do show symptoms, now we're going to get to what's really causing the economic slowdown and all the problems. And then we're going to get a feel for just how far have we completed the download. Think of this virus as downloading into the human population. That's what has to happen before this goes away. Is everybody has to essentially catch it and build immunity. Okay. And so it's very misleading because most people, 2/3 of the people catching it don't even know they've ever had it. So we're looking at 1.1 billion people who are quite likely going to catch it and show symptoms. Now, of that, we're seeing about 20% are going to lose oxygen. And they're also seeing this happening from 2 different mechanisms, which we're slowly figuring out. One of which is that ACE2 receptor in your lungs. So they can clearly see infection in the lungs and that there's no ability because your alveoli are swelling up and they can't let the oxygen go into the bloodstream. But there's a whole nother group of people who have no problems in their chest. They're plopping that little oxygen reader on the finger and they're still showing super low oxygen levels. And when that happens, the mortality rate is really, really ugly. So let's cut it in half. Let's just say for whatever reason, that's also overblown. So if we cut that in half and we're going to say it's only 10%, but I could tell you for sure, it's more like 20 to 30% are ending up with no oxygen. So we're going to do lowball it again. So I've lowballed everything on this calculation here, okay? Okay, the people are losing oxygen. This is the worst stat. We're recovering less than 25%. But let's do the opposite. Let's say it's the opposite. Instead of 25% recover, let's say 75% recover. Okay, so we're going to say only 25% of this group is going to die. Okay, so we're looking at, this is a low ball, 28 million worldwide deaths before we get anywhere near herd immunity, before Indonesians should think they're safe, before Singaporeans should think they're safe. Okay, so where are we at? 128,000. So let's just see what percentage of the downloads complete here. So 28 million. And we have 125,000 deaths. Okay, so if you use deaths as a leading indicator and you lowball every statistic and you realize you can't stop this, okay, you really don't have a choice. We can lock down, we can slow this down, we can hope we get a vaccine, but if economies open without proper precaution, then this will play out, probably worse. If they reopen with lots of precautions, then we may be able to get less than this estimated 28 million deaths, but we still win with our strategy because we bet that they're going to have to keep a lockdown on for a long period of time. So I would tell you, if this was a movie or a download, we've downloaded 0.5%. In fact, let's quadruple that. Let's just say I was still off by a magnitude. Let's say I was off by a magnitude of 10 times. Okay, then we're 4.5% done with the download. So no matter how you skin this cat, we're nowhere near flattening the curve. We're nowhere near the end of the pain. We're nowhere near anything. This is the very, 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 very start. Okay, so we do have some questions out there. So yeah, let's check on Indonesia in a month or 2 months, because in the grand scheme of things, we've just barely started this. Look at the reaction the stock market had just realizing, oh, there's a problem. Okay, but the problem hasn't even come in yet. The problem's going to come. So we've just begun the flick here. Ross, you have your hand raised, but you got to get your microphone unmuted. So if you could try to figure that out. Kathy says, so gold and bonds are really opposite. If you think growth is going to die and thus inflation is going to die, you want to own bonds. If you think the economy is running too hot and there's too much money slushing around and there's going to be inflation, then you want to own gold. So they're really the exact opposite. Now, I've got you owning both, right? So that's confusing. It's a good question. The reason why I've jumped the gun on gold is because we've done rate cuts and QE at the same time. So I think there's a chance that we might see gold lose its high correlation to the stock market. Mark says, I understand Sweden's population did not follow any of the recommendations put out. Do you know how the cases are doing in relation to the rest of the world? You can pull that up. And again, Sweden's a pretty wealthy country here, so it's be hard for them to cover up deaths. They could block testing all day. Oh, Ross, you got your microphone on. Very good. How's it going? Oh, still not having that audio. Ann Mai says, what kind of gain buying government's debt? Bonds, what's the best? Yeah, I like the TLT. And I do expect it to go up for at least 2 years, probably longer. So TLT is your 30-year treasury. Okay, great. Let's look at some more content here. Okay, so let's flip through the charts. But yeah, this is the math that's really kind of got me stuck with my thought process here. If we could open up the economy and go right back to normal, then I would say that we have the exact opposite strategy to play out. But once you do the math, once you understand that this, and really this discrepancy here is that half the population is going to get it, but 2/3 will never know they have it and they won't feel anything. That's the part that's dangerous, because then they have a 30-day time period where they go spread this to people who do have a bad reaction to it. And it's those folks that have the bad reaction that are going to cripple the medical system, cripple the economy, and force lockdowns, because people will be dying everywhere. Galaxy Note 8 has the hand raised. Go ahead, but you do have to unmute. Okay, I'm gonna go ahead and continue. Okay, so let's look at some charts. First, we always like to look at the TLT versus the SPY. And I just want you to see it. It works almost without failure. If the S&P 500 goes down, TLT goes up. If the S&P 500 goes up, TLT goes down, but not a lot. So it's really a great investment because the US debt is always growing. And if there's not a fiasco, they'll create one to ensure they can sell that debt. So I really like the bond market during this period of time. The only time you don't want to own the US debt markets is ahead of interest rate hikes, which are just absolutely absurd to propose at this point in time. Oh, Galaxy, you got your mic open. Go ahead. Who's that? Oops, they're not. Let's see. Jack, we will be selling the put and the 417 TLT call and put tomorrow. And then we're going to purchase a new downside protection for our put. Now, Ross says, sorry, I can't get my Zoom working, but appreciate the info. My pleasure, Ross. Always a pleasure. Okay, so TLT goes up, stocks go down, TLT goes down a little bit, but not much. The reason why is because the government is in cahoots with the central bank, and they are growing and growing and growing like a cancer. I'd love to crush the Fed. I'd love to crush the government, abolish it all. We'd be much better off, but that's just not the world we live in. We're really under hostage to these criminals. And so as I scroll through this, just see with your own eyes, if stock market is having a bad day, you want to own your TLT. It's really just that simple. If we think the economy is going to be locked down in any shape or form, then you just can't expect profit and earning growth anytime soon. So we don't want to be betting up on stocks. Once we realize the Fed can only print so much money before people lose faith in the dollar, you can realize they can't do that indefinitely. So there you go. You can just see it. We could go through the whole timeline. It works like clockwork. And that's really the basis of our main strategy. Now, normally we like to own stocks and bonds at the same time. But again, I think we're going to see a horrific crash in stocks. So we're just keeping our cash on the sideline to buy the best companies at the opportune time. When there's blood on the streets, even if it's your own blood.
When?
The timing, I think, will be around September is when we're going to be buying stocks. August, September is when I expect. Okay, next chart is just the SPY on itself. Let's go to a monthly view. So as I've been hyping up, this is a once in a lifetime, really more once in your lifetime, your son's lifetime, and your father's lifetime, and probably your grandfather's lifetime. So 4 generations won't see a crash of this magnitude. 2008 crash, dot-com bubble. I mean, come on. That was 300 billion misallocated, turned into maybe $3 trillion of assets, 2008. There's no lockdowns. I mean, really, what do? We gave people houses that shouldn't have had them, and we confiscated those. And it costs the government, right here, you could see what it costs us to confiscate that property. Okay, so let's just zoom out. Here's what you paid as a taxpayer to confiscate all that property. And we can only go back, let's see, right there. So, boom. Now look, the same thing is true then. They did that big jump in the balance sheet, but they realized they can't do that forever. It was just relatively slow growth from there. But we went from $900 billion in Fed's balance sheet to 2.1 trillion. And that wasn't enough. So it got as high as 4.5 trillion. Before Trump came in, did a bunch of economic boosters that gave the Fed confidence to hike interest rates, which again didn't last very long. And they tried to reduce the balance sheet. That didn't last very long. Everything began to crash. So this is minuscule to the crisis we're in right now. And we got a 50% correction. Minuscule. Same thing with the dot-com bubble. Let's look at history from a bigger point of view. Okay. here's what happens when you get a deflationary shock. You ended up with a 90% crash, 5,674 to, I think it got as low as, you can see it printed in the thousands right there. Just the most massive violent crash. So I do anticipate at some point the Fed will have to come in and buy stocks, but that cost will be so magnificent that they need to do it when stocks aren't worth as much. So I don't think they pulled that trigger because they know everybody would sell and it would cost tens of trillions of dollars. That's if it happened worldwide in all assets, which is what was happening. Everything was being sold at once. So a little bounce, great opportunity, more time for us all to get our head on straight. And again, I do anticipate adding risk, not adding new capital, but instead taking the capital I already have invested and putting a greater percentage of that towards shorting the market in terms of put options and betting on a bond rally in terms of TLT call options. So we've been patient. We let them come out with their bazooka. Should we have waited? Sure, we should have waited. But if we had missed the opportunity, it would have been gone. So you can understand why I didn't want to wait when it looked like every stimulus they were creating wasn't working. Now, the bond market's a weird thing. People like to look at volume and indicators and that, this and that. TLT is a proxy to the real market. So the real market's primarily traded by central banks and primary dealers. And then they resell that down the food chain. But the big picture is that this product just goes up over time as long as government feels like they should spend more money than they did the previous year. And guess what? They almost always think they should spend more money each year. So in the grand scheme of things, this product has been very beneficial as an insurance policy against your stocks. And so we can see the big picture has been lower yields over time. Here's the TLT as long as we can look back. And sure, there's volatility anytime you get a big stock rally, which is usually coordinated with QE, which is what we just had so most of in history, and we barely had drawdown. So that's a good telltale, right? All of these sell-offs in the TLT have been either extremely good times for stocks or extreme amounts of quantitative easing. And so the greatest amount of quantitative easing in history, and you can see that TLT didn't budge. So again, I do expect this to break out and go up as long as we're having a growth of debt. So that doesn't mean keep growing the debt equally each year. It means we're going to grow it at an accelerating pace. What is keeping TLT so low? Well, in the grand scheme of things, it's at all-time highs outside of 3 weeks ago. So I'm not sure how you'd say it's staying so low, but I will talk about that. Good question. Let's look at the yield curve. So what actually makes the TLT go up? This does. So TLT is a measurement of the value of the bond of the underlying asset. Oh, I live close to a fire station, actually. That's funny, Karen. Okay, so a bond has two pieces to it. You either want the yield. So if we go back to 1990, you could get a fat 8% a year. Boy, oh boy, would that be nice to have purchased, huh? Buy that 30-year and hang on to it, collect 8% a year, and then flip the bond for a massive profit. Sounds like a plan to me. What would have happened if you were buying bonds in the 90s? Well, again, it has two pieces. Either you're interested in the yield as part of the value of the bond or the bond itself. So if yields go lower, value of the bond goes up. Yields go higher, value of the bond goes lower. So we're betting that yields go lower when we bet on the TLT. And yields tend to go lower when the Fed cuts rates to 0, which they just did. So what's the plan? Government wants to sell trillions of debt because they're not collecting tax receipts. We're having a tax holiday. MI says, should I buy call options on Tesla and Amazon? No, I think that opportunity is gone. So I would focus on long-term puts. Now, was I hoping for an unbelievable, breathtaking rally? Yes. Did I think we may not get it when I put on that first tranche of puts? Yes, that's why I had to finally pull the trigger. Did I use all of my available capital? No, not even close. I have so much dry powder. We have so much dry powder to load up and be patient and get the big play. So no, I wouldn't do that. But let's just look at the right column. This is the yield of the 30-year Treasury over the course of time. It bounces up and down, but 7, 6, we're going through the decades. We're in the mid 90s. It's at 6, bounced up a little bit. Get to the 2000s, we're in the 5s. Going into the 4s. Dropping down to the 3s. So what's really happening here? Well, I'll tell you what's happening. The government is spending more and more and more money that it doesn't have. And the Fed engineers it so big banks buy the debt, they hang on to it. We have a stock crash and they cash out with quantitative easing and buy stocks and rebound. So you can just see it just goes lower and lower and lower and lower and lower and lower and lower. And here we are at current days. This was when we had that huge pop, which we wish we had sold everything that we had on the TLT. We didn't. We held. We're back towards where we were at. Not as close, but that's where I think we're going to see the Pavlov reaction, where people know to take profits as you get near that 1%. But I do believe we're going to blow way beyond that because the amount of debt we have to sell. So we're at 1.4 today. So that's what we're betting on, is yields go lower. And again, this is a mechanism that's designed for central banks, primary dealers to have low risk, high returns. That doesn't rely on the real economy. It really just relies on the Fed keeping rates low, the banks, and then they design QE to force people to hold this until, again, the government raises the money it needs to fix the problem, to get the economy rolling again. So banks love to find troubled companies. They go in there with a convertible note. Company can't pay off the note. They convert it into a huge chunk of your company. So banks love problems like we have right now. But this problem's so big, they can't afford it themselves. So they have to use the government to do that. So all the banks are going to team up, loan the money to the government, which they're borrowing from the Fed for free. How handy. Government redistributes the cash to those in trouble, fixes the problem. During this whole time period, stocks typically crash. They don't go up. Once the problem has been resolved, the loss of the economy has been absorbed, the banks get the payout. And that's when the Fed comes in with more QE. And again, it's a guaranteed profit. So it's really the big picture playing these debt markets. And so follow the money. The big money is going to the government debt products. No question. So in terms of predictions, if you look at 2008, it's hard to see in this monthly chart, but the bulk of these big red candlesticks were single day moves. Something like 3 days in 2008 and 9 of that crash. Oh, sorry, of this crash, which you can see there's only a few down moves. This is really just a handful of days that took the S&P 500 down 50%. So it only takes a handful of massive selling for our put options to go into that profit zone. So that's really the big play. I think we're going to be sitting here on our puts. Not a lot's happening. And then again, you get a few ferocious weeks, and then the repricing has occurred. So that's a play on those big returns, 500% plus, 5,000 probably maximum with the setup I have in our existing trades. Now, people joining in on those puts today obviously could probably get double that. So that's the type of return we're trying to achieve on some of those different put options. So obviously the further the strike, the more leveraged and the longer you'll have to wait. TLT is the opposite. Government wants to slowly sell this debt and to force everyone to buy and hold the debt while they slowly collect it and redistribute it. So TLT is exact opposite prediction, slow, steady grind. And I would predict this goes up as long as growth doesn't just grow, but accelerates. So what do I mean by accelerate? Well, it's back to that logarithmic scale. That's what really will punish stocks and benefit bonds is a accelerating growth of debt, not just a steady. So this is linear. Be if this was just going up nice and slow, but it turns exponential when you go to log scale. And so that's what we have is we have an exponential rise in government debt. It'll take time to sell it all, and they're going to make everybody buy and hold that till the problem is finished. So yeah, I think this will take no less than 2 years for them to sell all this debt. So that does mean it's going to be probably quite rough for stock market during that 2-year period. And it could take longer, to be clear. Okay, US dollar index, great indicator. Let's look at a bigger picture of that. So despite all the money printing in the world, cutting rates to zero, giving every central bank free access to the dollar, they can't get enough of it. So it's still at an elevated level. And that does incentivize investors to sell stocks to get their dollar needs met. They can sell one of three things. They could sell their dollar, but they need them, so probably not. They could sell their currency into the dollar, which again is what directly causes this. They could sell stocks for dollars. Well, if you don't think the stock market's going to stay at these high levels, which quite frankly, you'd have to be crazy to believe that would stay at these levels for long, and you thought treasuries were going to appreciate and plus generate risk-free income, you know, ask yourself, what do you want to own, treasuries or stocks? Well, probably most people want to own treasuries and sell their stocks after such a nice little pop the Fed gave us. So dollar index is critical to watch. All right, how low can yields go? Well, German 30-year Bund is a great leading indicator, and it's now back into negative territory. If we want to believe the TLT could go above 300, then we want to see the German Bund go really low and continue to have this spread. So if you see this spacing between this 30-year Treasury yield and the blue German Bund, as long as we keep this spread, then I would anticipate that we can see this 30-year continue to chase the 30-year of the German Bund, because it's a relative game. We're fighting over foreign lending, and as long as we have a better yield than everybody else, relatively, we could keep pushing this lower. So China's doing great, supposedly. Germany's one of their best trading partners. So that's something to consider, that perhaps the US spread could get reduced. But I do believe we're going to put a lot of sanctions on China and anybody who does business with them. So even if this spread were to slip for a little bit, I'd wait until we see what sanctions are placed on China to think that we're at the end of the rope for the Treasury. And also, again, until we've raised all the debt that we're promising, this really has to continue to drop. Okay, let's see what we got here. We got FXI in orange, and the SPY's catching up. All right. It was underperforming China for quite some time. Caught up. South Korea does often act as a good leading indicator for US markets, and you can see it's starting to lead the pack back down. China had been outperforming during this stretch, as you can see, but I think we'll see some geopolitical attacks shortly. Gold market, spot gold is in the candlestick. Then we have the SPY in purple. So these really do well when full employment, inflationary pressures that the Fed's ignoring are occurring, and too much money in the system. They do really bad when you have a demand shock and disinflationary pressures. So my expectation is gold is going to pummel alongside stocks, unfortunately. Now we have gold miners with a small position protected by puts. So we're starting the clock so that we can start to sell those in a year or two into some spot silver. And we've studied that 1-2 punch is that we want to own gold miners first for the best return. And then we want to rotate into spot silver after it really, the inflationary fear starts to pick up. So if we buy gold now, protect with a put, we're going to sell our puts at the bottom of the crash as best as we can aim that, hold on to GDX, and then in a year's time frame, start looking at some small rotations from GDX into silver. Again, we want to hold for a year to get that lower tax rate. Ram says Chinese central banks are working on issuing a digital tender. Yeah, so actually before the crisis last year, they rolled out their digital currency, and now they're burning cash because it's going to infect everybody. So a lot of people are saying that this is a strategy to create a bio ID. So you got to all be ID'd with a chip, and that we're going to get rid of cash so they can control you, tax every penny. So that's my outlook. Now, again, they usually do rate cuts, raise the money, then QE. They're doing QE early. I do expect that to taper off. So that's my justification for having some gold exposure early. And not spot gold, but we're doing the mining companies. Okay, are any currencies holding strength against the dollar? How about the Japanese yen, the euro, China's currency? Not really. You can see the dollar index continues to rise. China's currency has a little strength, not a lot. They did get added to the IMF basket. Europe's currency is going down. The yen's showing a little strength. Again, negative for stocks, and the Aussie dollar is crashing. So currency markets painting the same story. Here's oil.
You have a question, Dave?
I do, yeah.
Oh, go ahead, Dave, please.
Hey, how you doing, guys? I had a question about, China's position in the pharmaceutical, the pharmaceutical problem that we have in this country. How does that factor into this, and does it?
Yeah, so I guess that's two really big disasters waiting to unfold as China cuts us off from all the medical supplies we need, which I believe they've been doing to some degree. One, and then two, they're just going to cut off all supply chains in general. So yeah, both of those are certainly a factor. And then three, we see all of our China hawks arguing why I told you we got to move manufacturing back, even if it means tripling costs. So yeah, certainly, I think we're going to have problems getting stuff out of China.
So what do we do? What do we do here? Do we have something to meet, to take care of that problem? Are we opening up manufacturing anymore? That I heard some talk about it the other day, but what plan do we have? Do you have any info on that?
Yeah, Kudlow was talking about trying to pay for everybody to move their manufacturing out of China to US. So I think we're going to see that around January, China not only lied to the public about what was happening, they went around the globe and they confiscated and massively purchased all the drugs, all the masks, all the equipment necessary for this crisis, and collected it all. And now they're refusing to ship stuff. So they are keeping all that quite hush hush. I think the administration does want to stabilize the economy, let the citizens cope with this new reality, get a game plan that works to at least get the economy operating to some degree. We can't keep it shut off completely. And I think what comes out next is a lot of nasty things against China. So yeah, no, we're not prepared for it, Dave, and they're slowly figuring it out. There's not a lot of information out there.
All right, thanks, appreciate it.
All right, and great point.
I'll have to email you my theory, Jason. I got another one.
Uh-oh, what? You could tell us.
Kind of like how I felt before in December with that trade deal. I
Uh-huh.
got one about this too. I'll just leave it at that and I'll email it to you. How's that?
Okay, sounds good. Well, hey, you've been dead on.
Yeah, well, I got a feeling. We'll see.
Yeah, I don't have any good feelings, that's for sure. Oil's crashing again, so they're all talking about cutting output. Which what does that tell you? If they're cutting output of the most important resource in the world, really the ultimate resource, we can go flip. We can go buy digital clothes on Fortnite all day, not really creating increase in output. Could go buy some tennis shoes. Maybe it helps me run around a little bit, but you go buy a barrel of oil that produces a lot of output. So oil is extremely important, and it really needs to get back to that 50 level one way or another, whether it means cutting output. But a lot of American oil companies are going to be going out of business because of this low price. And so it's two, it's one, how many barrels are being produced. It's a good measurement for how much economic output you can expect. So cheap oil, I've always told you guys, means stock market's in trouble. So cheap oil, here we have primary indicator that I'm looking at, or at least the information I'm getting from oil. Now, even if it did shoot up to 50, if they're producing half, that's still not good, right? Not to expect our stock market to get back to where it was. Now, I do want to buy some US oil companies again, probably same time we're selling those puts, because I believe we have to protect our energy sector. And again, we're going to see this just global. Everybody's going to want to produce everything themselves. No one's going to trust one another. A lot of nationalism. And again, that's terrible for commerce. So another reason to buy bonds and not buy stocks at this point in time. This one, I think we can pick up not 50 cents on the dollar. And again, I'm not looking at crude oil, but rather the US oil ETF USO, and then the US natural gas. I think we're going to have to protect those industries, and we may be able to pick those up for 10 cents on the dollar. So can't wait to do that. There's going to be some great buying opportunities for those who are patient. Look at Amazon dragging ONLN up so high. I just don't think that will last. If everybody's unemployed, economy's at half its output, everything has to get repriced, recalibrated. And then I do believe Amazon, and again, there's a bunch of good e-commerce inside of ONLN, and it doesn't cost so much to have 100 shares and be able to protect with puts because of its ETF. So better diversification. And again, look at that outperformance, beautiful, but I want to see it outperforming at half the price. So you can still see this extreme correlation. And again, that's why we're waiting to buy those. Okay, finally figured out how to get a chart that we can see visually that makes sense. In this chart, I'm comparing the QQQ, sort of like a tech on steroids version of the SPY, and Ethereum, which is something like Bitcoin, but more leveraged as well, or smaller market cap. And so crypto, the same big players who are buying and selling everything seem to have a position in cryptocurrencies. And so we're seeing that crypto tends to sell off and give us a heads up before stocks crash. Same with the South Korean ETF, same with oil. So as you know, I like to look for some sort of canary in the coal mine to give us a heads up. And so I did find these charts you could see on the same page relatively better. So right now you can see Ethereum and the QQQ going up together. we saw them both crash together. And so I am keeping a close eye on crypto for a mega crash, as it will likely be the first weak link to fall. So if you're in the boot camp, I do like cryptocurrencies, but again, it's the same correlation to the stocks. And I think we can get it super cheap if we're patient. So I'll cover that more in the boot camp material, but another chart we like to look at. Now, is Bitcoin any worse than Ethereum or Ripple or any of these other random coins? I think it's the same story we see with gold and silver. Most likely Bitcoin is going to dominate for quite some time, hit a very huge return, and people start taking Bitcoin and converting it into some of these other coins. So I still think your best bet in the crypto world will be Bitcoin. And in the gold world, let's go back to that gold comparison. So let's go back to the most recent crisis. And again, it's not the same. It's just not the same. There's nothing similar about the 2008 crash and this crash other than the Fed's playing with the money supply. So again, they cut rates and then they came in with probably a quick shot of QE. I think they're going to pull that back and do another big shot of QE once the problems have been resolved. But they do need to help the bond market force investment, and they can do that by not doing QE. So gold initially did well. Spot gold right here in the candlestick. Purple's your SPY. Orange is gold miners. Silver is spot silver is yellow. So when the crash first begun, we had inflation. So we had runaway inflation. And we had the stock crash. And the first move was a move up in gold. But as stocks sold off significantly enough, we saw gold come down with it. Now, did gold bounce back up? Yes, it sure did. With stocks. Okay, but if we do zoom in, we can see what was the best performer immediately in this period. And so here's where we got towards the bottom. This is where they, November is when they came in with the announcement for QE, and I think they released it right in this area. But you can see gold miners react to the news way before the S&P 500 did. And that's when gold miners had this tremendous rally. And in relative performance from its bottom, outperformed gold. So gold went from a negative 20 for the first year to a positive, let's see, it went from negative 18 in relative performance to, let's see, sorry guys, negative 20 down here to 29% return. So about a 50% gain in that first year coming out the gate once the stock market had really bottomed and we did QE. But the gold miners went from down 56% to up about 7% right when gold peaked right here. So it picked up a bit bigger of a return. Then all of these performed about the same right in this period for another year. And then finally you had your silver shoot up. So I like the gold miners for a few reasons. One, I like their business model, cheap oil, and there's a huge demand for spot gold. Okay, so that's one. But two, spot gold is mainly controlled by central banks. And if they're trying to force the world to buy more government debt than they ever have in history, and they're shorting the very asset we're trading, which is GLD, then that worries me. And they don't have the actual underlying asset in full capacity. So it's a 10-to-1 leverage product. GLD has 1/10 the gold relative to its assets under management. And the big banks holding that are shorting the position. So I just don't like the the mechanics of how GLD works. So that's why I really prefer GDX in this environment. Sean, please go ahead.
Okay, you can hear me now, right?
Yes.
Yeah, I want you to say a little bit more about oil. It's you seem to say that it's bound to go up from this low level, yeah, and want to know if it's a gradual trend that has to go up because of various reasons you mentioned. You know, I mean, it's a dead simple trade. It's just bullish oil because of the low price and, you know,
to be clear, I think it's going to go far lower first and put many companies out of business. And then the supply will be reduced and it will gradually go back up.
Can you talk in terms of the WTI crude oil price?
You want me to pull up WTI?
Yeah.
Whew. That really says it all right there. There's your demand for economic growth. Nothing.
Is it low enough?
No, I don't think it is. The companies have to go bankrupt first.
Companies have to go bankrupt first.
Yeah. So what's, imagine you have a company that's hurting for money.
Yeah.
What are you going to do? You're going to sell all the oil you got. Even if you know you're going under, you're not going to just hold on to your assets. So yeah, it's low. And I'm not trading crude oil either. So my interest is to find the companies we want to buy and hold for a long time period, which are the US oil companies. But after, again, we got to realize how long is this pain? How long are we going to have economic slowdown? And I think we're going to have an economic slowdown for a long time.
So the chances of crude oil to WTI, in terms of WTI crude oil, coming back up in price is not realistic, right? So
I think in the long term it will, but in the short term it has more pain ahead, is what I expect.
And your long term is how many months?
Unfortunately, I think we have about a year
or two.
You
cannot stay so low for so long. So that's sort of like the similar view to my friend who's going to create a really big position on crude oil, because he thinks that it's quite low already and it's so ridiculous how many years, blah, blah, blah. And therefore it's not going to be so low for so long, which is similar to the same sort of insight you tried to give. And I'm just saying that if you're so similar, so how do you see the future? 6 months from now, what should the price in the WTI crude oil be like? It's now 20.
So it's a supply demand equation. Okay. So I think the demand is
down.
I believe the demand will be low until this is complete. So
but this is going to take at least another year.
But if the supply is gutted because they all go bankrupt, so if I was trying to catch a bottom in oil, where is it? There we go.
22 around.
I would wait quite a while. I would wait 6 months, and I think you'll have a better opportunity. Okay, but I'm looking at USO as really the investment I'm interested in, because I do believe the government's going to protect these companies. But I think they have a lot more pain first. So this is going to be a beautiful investment here.
The oil going down lower because some of its drilling requires the price to be high in order to be profitable.
Yeah.
If the oil price goes down some more, then that's dead end for US oil. I mean,
yeah. Oh yeah.
Drilling and all those things,
Right. So we have all the oil companies coming to Trump begging for money right now. They haven't gone bankrupt yet. So I would watch for lots of bankruptcies to occur. Then they're going to liquidate all of their assets.
So you mean,
and then we're
you
going to have
have
some
to-
opportunities here.
so you imagine that the price will go even lower than now, even lower than now. I mean, it's not like my friend who insists that, well, you know, we've never seen oil prices so low before. It's impossible to go any lower.
Yeah,
And that's
it's not impossible. We're going to be at the point where they're going to pay you to take it away. So yeah, I like to listen to, we gave you guys this, not this Tuesday, but last Tuesday, great Macro Voice episode with Art Berman. So that's who I really look to for insights into the oil market. Yeah, I think over the course of time, oil will come back to 50. And I think the supply will be much lower at that period. To get the supply much lower, we need a lot of oil companies to go bankrupt. So
what
I
if
don't
they
think all
don't?
the
What if Russia has a lot of these so-called almost break even but not quite small oil drillers? I mean, that's I've been listening to the news a lot, and I think one of the reasons why the price is sort of steadying is because Saudi Arabia has sort of promised to cut the supply, right? But making the oil volume lower is not in the interest of United States or Russia, because Russia also has all these mines that cannot shut down just because, oh, we don't need that much oil anymore, or, you know, it's just not profitable.
Oh yeah,
Because
you're
they-
asking some of the most ruthless groups of people in history who protect their oil at all costs. I mean, they
Yeah,
are
they
ruthless,
will-
ruthless
they will
assholes.
produce.
Who,
They
yes,
will produce even if it makes no sense, you know, because they want to keep the oil field open. Yeah.
if I was
Or
buying,
something.
if I was trying to play the oil market with like say futures or something of that nature, you'd want to do like the married put strategy with like a year put. So buy up your big oil position, buy the married put for at least a year of protection, and you could make a killing. Absolutely. That's a high risk strategy. For our group, I think it's critical. America is energy independent. So from that standpoint, I think we're
The
gonna
oil
have-
price cannot go down lower, because if
it
if
can,
you want to,
it can, and it probably will. So I think it will go lower, and that this ETF USO is going to go much lower, and this could be really the best opportunity in the energy space of our lifetime.
before it will come up, you mean?
Yeah, so we need to let them have some pain. They haven't. I mean, this oil drop's only been a month. Imagine what their balance sheets will look like after 3 to 6 months of slowed economic. So yeah, everything that's happened so far is just the intro. It's just the teaser. There's no solution that gets us around this. You could print all the money you want, but there's just no getting around it. We really need this to spread through the population and get it done. Until that happens, we have slowed economic output, which means less demand for oil. And until the people go bankrupt, they're all going to keep selling oil to survive. So you end up in this environment where people have to sell it at a loss just so that they can keep the bills paid, keep the lights on.
Okay.
But yeah, I think in the grand scheme of things that at some point in time, it will go much
You
higher.
see
But
the market coming actually sustainably up when 6 months, 1 year. 1 year is a
2
long
years.
time.
I think we have a 2-year depression ahead.
Oh, so before then, it probably go down some more. Wow.
Yeah,
I
so
mean,
the oil
that-
market has a lot of
that's
momentum
really
against
sad.
it. I think you could catch a good oil. So again, I do think we can pick up some good investments being long with the married put strategy late
Yeah.
this summer. Late this summer, I think we'll have some good opportunities. Now, do I fear that we're going to have a fake rally into Christmas? Because we let everybody go back out and then we just accelerate the virus again. That's my biggest fear right now. So at this point in time, what I can tell you is I expect economic output to be extremely hampered, handicapped. And that's bearish for oil. That's bearish for stocks. And it's very bullish for the treasury market. Now, depending on what our leaders decide, if they just let this rip through society, that's actually going to cost the least economically. So we'll get our bottom much sooner. But if they try to slow this down and save every life possible, then the solution is to keep this in lockdown for 2 years till a vaccine comes out. So really, and I showed you guys a chart where the guy was estimating how far the stock market crashes based on death. I actually think he had it flip-flop those estimates, and you're probably gonna be right on. If they try to save lives, it's gonna come at the cost of the stock market. If they want to save the stock market, it's gonna come at the cost of many lives. And so we can't stay locked down forever. We're all going to go broke. America already is broke, right? We have the greatest public debt held by foreigners ever in history, much less any other country currently. So US is already broke, and we're going to tap out that line of credit now, which we did without even asking. We didn't ask all of our lenders, hey, you don't mind if I devalue your loan by what is that? I mean, relative value.
Not really.
We devalued. We went from 4.5 to 6.
But it's gone up. The US dollar's gone up.
So yeah, we devalued our currency by 25%. Give it a little time. And we're not done. We're going to keep devaluing that currency. Let's look at some other charts. Okay, so we have the federal funds rate, like clockwork. Fed predicts problems. It's easy. When the banks have a problem coming that they can't afford, they go to the government and say, hey, it's too big for us to pay for. You pay for it, we'll all pitch in. So government says, great. Fed drops rates to 0. Banks borrow for free. They give it to the government. A scheme and a half, sure. Just that action, as you can see, causes stock crashes like clockwork. But the good news is it gets the money to the government. Government can go hand it out to those who need it. The economy absorbs the losses. And we do it just by expanding the money supply. So we're just diluting everybody who's saved anything and using that dilution to patch up the holes in the ship. So like clockwork, rate cuts precede stock crashes and big bond rallies. Okay, there's a few times in history where we've done some rate cuts and no stock crash, like right here, a little bit right here. You know, we did a little bit of adjustments, tiny little rate cuts. Last year had a good stock market, but when you go to extremes where you're just dropping it to basically 0, you're just trying to make it so the banks want to buy bonds. All right. Balance sheet. Okay. That's where we see the value of the dollar losing relative value. But they only tend to do this when we have deflationary forces. So they're trying to create inflation. So here's our long-term yield. This is one investment you could have just bought for the last several decades and never even thought about it and just racked up profits. with low volatility. It's beautiful. It's the bond market. Nobody knows how it works. And it's probably going to test the limits here by approaching zero, maybe going negative. So that's how we get to those extreme valuations on the TLT. Inflation. All right, we got our inflation. This is usually part of our big picture course. What breaks their system? Inflation breaks their system. So they'll sit there and print money, use government to do this, and then you end up with periods of time that are horrific. So I think the most relative time. So leading up to this, I was really interested in the 60s. We're just being reckless with government spending, with corporate debt. And I believe we're going to end up in an environment with runaway inflation. So the inflation numbers are here at the summarized for the year in the final right corner. So this is a period of time that's hard to navigate. Most investors not prepared for. And your risk parity stock bond strategy just goes to complete crap because it causes the Fed to hike rates. So notice prints above 3 are very bad for stocks and bonds. Okay, so that's the runaway inflation in the 70s. Let's just look at the stock market during that period. So you get up to 1965, and then you get Paul Volcker, and he comes in and hikes rates over and over and over and over and over again because all of the money spending after he came out of World War II was outrageous, and it slowly but surely got into an environment where things were too hot and you got price inflation, and that's bad. So stocks and bonds went down for 15 years. So you want to know how long I think this could really last? Well, what if we print too much money, trying to cover up the patches? Makes sense right now. And this money starts working its way through the system, and all of a sudden we get runaway inflation. And now we have to hike interest rates. Unfortunately, I do think that could be coming. So we're gonna have to be very nimble. There's lots of big rallies you could have played, but there's much bigger crashes. A big rally, big crash. So if you bought stocks in 1965, so screw it. This market's unbeatable. From 1941 to 1965, it's gone straight up. I don't care if I have little pullbacks. Well, bad news, you held till 1995 to get back to even. 2 decades lost to break even. And you lost up to from 7.2 to 2.2. So you lost over the course of, what is that? From 65 to 75 right here. So in the first decade, you lost half. The next 8 years, you really got a nasty crash. That's the period of time we could be facing if, let's go back to our inflation, if these start to get hot for a long, long time. Now, what keeps inflation low? Well, globalism keeps it low. You outsource stuff to China, you create machines, you automate, that keeps prices low. You go loan trillions of dollars to Netflix and let them lose it's not trillions. Companies like Netflix, lots of these companies have taken advantage of the corporate bond market. They're losing money, but they don't care. They're trying to take over market share. They're delivering goods at a loss. We created an environment that now rewards companies that lose money but keep prices low. And they do this with debt. So I think over the course of time, these numbers get hot. That's when you get your big gold spike, and then the Fed reacts and crashes everything under the sun. Okay, and that's when they hike rates. And that's also how they could weaponize the dollar and punish foes. So timeline, first they got to fix the problem. They're going to let inflation run hot and just look the other way. So that's kind of looking at the big scheme of things right there. Let's see what other charts I got for you that are interesting. So we like to look at inflation. We like to look at the growth of debt. We like to look at periods where there was inflation. You have to change your whole strategy. Short stocks, short bonds.
when is inflation likely to come?
Well, I think we got to get unemployment back to extreme lows. One, and then two, start moving all the manufacturing back to America. You know, there you go. There's your combo punch. So print trillions of dollars for 3 to 5 years. Okay, check mark. They're going to do that. Two, move manufacturing from China to US. Guaranteed you're going to spike prices. Okay, so go from globalism to nationalism. You're going to protect your national security, but you're going to certainly create inflation. Let's pull away the free money to all these globalized companies who are losing money. That'll stop all the giveaways. So yeah, there's a lot of forces coming. I'd say it's coming in 3 to 5 years.
Yeah, because oil is really low price now.
Yeah, so for me to really think we had an inflationary shock, I'd want to see oil back above 50, probably heading towards 80. I'd like to see our production back at full capacity, and we have to get unemployment. We got to get everybody back to work. Otherwise, we have very little chance of an inflationary shock.
Yeah. Unlikely.
So, you know, you got everybody and their mom jumping in on gold saying it's the only investment, but I still think you're really, really, really early. I know we have a position. You know,
But
so
there's
many
no
people,
inflation.
Yeah, there's no inflation. There's deflationary shock coming our way. So bonds, 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 bonds. This is your lady's best friend is a diamond, and your best friend is the TLT. Until the problem's resolved, until we get people back to work. Okay, what happens then? The Fed's going to do the big QE, vacuum all this debt out of the market, and the banks are going to buy stocks for cheap. And they just do this over and over and over again. It's fascinating that people are surprised that they pull the same trick over and over again and destroy people's retirements. They do the same thing over and over again.
Yeah, I agree.
So this is by far my favorite pick is TLT. And it's backed by the Fed. It's being bought by the central banks. You want to buy what the banks are buying. They're buying debt. All right, guys, I think that's pretty much my core presentation today. See if we have any other good questions out there or comments. Anybody want to just joke around, say anything, introduce yourself? Love to hear from you. Michael saw my picture on Facebook. What you thought I looked like, Mike? I bet everybody's going to try to find me on Facebook now, which is fine. I don't care.
Oh, you bet.
Uh-oh, Karen's on it. Yeah, you know, it's funny. I see all these people just insist on putting their picture, their camera on their YouTube channels. It's so funny. I guess I don't know what it is. It's celebrity status. I don't know what the.
That's us.
I don't dare friend you because then you'll really get a picture of me and then you'll put it on your blasted website.
That's right. That's
right.
Ryan. You're lucky I'm not on Facebook. I get you all.
Oh yeah, Ryan doesn't like any of that Facebook. For years he hasn't liked Facebook.
What a relief.
I know, I can't stand it either. But unfortunately, after you retire, it's about the only way that you can keep in touch with certain things that you need to, especially from a previous employer, because you're not allowed to, and they monitor everything. So you got to be careful. It's crazy. I mean, not just Facebook, we know that, but the employer. So you have to be careful that whole the agreement goes along with you, even though you could be gone for 20 years. It goes. It's crazy. But oh well.
Too funny. Mike, you got your hand up?
Yeah, I don't use it for you know, keeping up with status or this or that. I use it for some groups because I believe too that too many people live out there, can stalk you. So
Yeah, if you go through Jason's photos, you'll probably find pictures of me in there being a wild man.
We'd have to see a picture of you to, you know if we're looking at the right person there, Ryan. You'd have to help us out.
Right.
One cool thing is for exercise before this COVID, I was kickboxing. They shut down the gym, and they're doing kickboxing through that platform. And the instructor, he just goes live and does his 45-minute routine, you know, from the gym, but he's by himself, you know.
Oh, that's
So,
cool. Yeah, that's very cool.
yeah, but anyhow.
All right, guys. Well, let's go ahead and close up shop. I appreciate everybody. We kept half the crowd for 3 hours, so bravo to you for sticking in there the whole time. Appreciate it. Hope you had fun, learned a few things, and have confidence. You know, we haven't really changed much and don't intend to change much, but we can look forward to a little extra exposure to shorting the SPY and betting up on bonds Wednesday and Thursday. Now, if I think they're going to put on a whole circus act and pump the market a little higher, I'll delay it another week as we have for the last few, but that's what I'm thinking currently. And yeah, that's a wrap. Really appreciate everybody. Look forward to seeing you guys on the boot camp. I'm going to test out our software today and hopefully release the new platform tomorrow. It's quite a relief. I'm not updating 20 option prices every day haphazardly right before the trade. It's just updating on its own. So it's beautiful and a great add-on. So I look forward to getting that out. And we'll see you guys tomorrow. Thank you so much.